the June Note Weekend training class. As always, Scott Carson here. Excited to have you join us here for the next couple hours as we go through the basics of note investing. We'll dive into kind of what note investing is, the different types of notes that you can buy, how to fund these deals, how to evaluate them, how to find the deals from the duds, and how you can start diving in today, if you want to start finding some notes available as well for you. If you guys don't know me, my name is Scott Carson. I've been an active real estate investor for over 22 years now. And Austin, Texas is home, but I buy all across the country. There are a few states that I avoid that I'll get into later on. But I've been buying debt since 2007. And that's all that I've focused on primarily is buying non-performing notes since 2008, to be specific. Bought over 1,000 deals, but I am most proud of the fact that we have helped thousands of students close on thousands of deals and either add cash flow, add equity, add big checks to their bottom line. Because one of the great things about being in the note business, we call it the sexy side of real estate, because three things that I love right off the bat is first and foremost, you're much closer to the deal flow as we get banks and lenders and hedge funds and other note investors to send us deals on a weekly basis that we can cherry pick from. No direct mail marketing. Two, we're buying these at bigger discounts, not having to pay full retail, not overpaying off the MLS or anything like that. We're getting at bigger deals, 40, 50, 60 cents on the dollar, sometimes up to 70, but usually getting a substantial discount. And we're seeing deals 6 to 12 months ahead of most folks. And then finally, since you're buying at a bigger deal, you're getting more deal flow, you can be picky, and our ROIs are often through the roof. So if you're looking to make more money, avoid the competition, and do this from wherever you live, wherever you call home, and feel free to type in the chat roll. Let me know what part of the country you're living in. I know we got some folks in God's waiting room down in sunny Florida, Miami, Orlando this morning join us. We got people probably going to be joining us from all across the country. But we're honored to have you guys here join us for the next roughly 3 to 4 hours as we go through the basics of how to get started as a note investor. I bought my first note back in 2007. Now I've structured a lot of owner finance notes and done simultaneous closings. We will not be diving into how to create a note. We will not be diving into owner financing deals today. My niche over the last really 15, 20 years has been buying non-performing notes, distressed debt from banks on residential and commercial properties direct. And that's what we'll focus on is the niche. Look, I think owner financing can be a great strategy, especially if you're got a troubled asset. If you're upside down or have issues, that can be a great thing. I do not like buying a silly, I mean, buying owner finance notes is fine, but I don't like to target that niche because it takes so much work to find deal flow. Never been a fan of sending out thousands of postcards to get a very small return of just tire kickers. I like working with banks because they send me lists on a very regular basis that I can cherry pick from. I don't have to buy the full thing. Hey, Adam, good to see you from Wheeling, Illinois. Thomas, thank you from saying from Orlando. Good to have you here across the country. And like I said, if you're watching this live on YouTube, please comment in the section so we know where you're at and can see that you guys are on there and paying attention. But anyway, guys, a couple ground rules before we kind of dive into stuff. I want you guys to take away a lot of great nuggets. And one of the things we started teaching this course back in 2020, it's hard to believe we've been teaching this course at least once a quarter, sometimes monthly, since then for 4 years now. It's a great way to dip your toes in the water, see if note investing is the right fit for you, and help you take your businesses to the next level or your real estate investing to the next level, whatever it might be. Maybe you're going from 0 to something or going from 60 to 100. We're here to help you. And you're in the right spot. We're very proud of the fact that we close notes. My company is the #1 investor recommended when it comes to training for note investing, to buying non-performing notes from banks. We're also proud that we have the #1 YouTube channel at WeCloseNotes.tv. If you're not subscribed to that, go ahead and do that now, WeCloseNotes.tv. And of course, we have the #1 and longest running podcast for note investors, the Note Closer Show. 835, I think we'll be at, by the end of June, we'll be at over 870, 880 episodes with content. So we're really proud of that fact that we just keep cranking out content for you guys to take advantage of, you ladies, guys and gals up there. But anyway, there are some great things. I want to welcome you here to Note Weekend. Like I said, this is a fun class. I enjoy teaching this. It's kind of the basics. You're not going to learn everything in a 4-hour class. And I encourage you to ask questions. I really do want you to ask questions. I enjoy it. It makes teaching that much more fruitful and enjoyable when you do ask questions. But I do want you to stay on point. If I'm talking about contacting banks, don't ask me about structuring deals. If I'm talking about raising capital, don't ask me about foreclosures. Please keep your questions relevant and on point. We will take quite a few little breaks so you can ask those questions there. And if I don't cover something, I'll open up at the very end for stuff that if I didn't cover, I'm glad to dive into and go from there. There are no dumb questions. I just ask you to stay on point. If you keep, I've had somebody in there and ask me all these weird questions that weren't on point. I had to kind of silence them. Don't want to do that. So do that. Second thing, these sessions are all recorded. You will all get a copy of the replay to go back and watch this again and again and again. So if you've got to skedaddle for a reason or two or something pops up, do not feel bad. We'll have the replay out to you probably by Monday. We'll actually restream this Sunday tomorrow across all our social media too. So if you can't make it today, you'll be able to catch this on YouTube, social media, LinkedIn, or whatever tomorrow, which is being Sunday. Respect your fellow investors. One of the best things that I think you have to realize is that you are not in this alone. I know that many of us come from real estate investing where we're the jack of all trades. We have to do everything. We have to buy the asset. We've got to rehab it. We've got to do the yard work. We've got to sell it. That is not how it works here. Plus, the fact is that you may be so used to buying your backyard. Well, guess what? You have to get beyond your backyard. And depending on where you're at, it may be better for you to invest outside of your backyard than it does in your backyard. And one of the ways that you do that is by building a network of investors to help you with due diligence, help you do drive-bys, help you to look at your deals, maybe even help fund your deals. So respect your fellow investors. I don't care who wins the election. I mean, I actually do care who wins the election. I don't care who you vote for. I don't care if you're a guy or a gal or what you call yourself or who you sleep with or what color your skin or what you look like. Everybody is a buyer, a seller, or a funding source. And that's the way I look at it. All right. Respect your fellow investors. If you're rude or any type of comment or question, you get rude, I will boot you out. No questions asked. So treat your fellow investor like you want to be treated. Use the golden rule. I think we can all apply to that as being beneficial out there. And like I said, we encourage you to network with us and others that are on this. So at this time, if you want to go over and pull your LinkedIn profile, the link for your LinkedIn, share that in the comment section. Okay. Hey, how do you do that? You go to LinkedIn, hit your profile, hit home, and go up and copy the link, copy the URL for it, and post it in the chat roll and let people connect with you. If we've got some time at the end, we'll even open up for some public networking, bring you on camera, let you share what your focus is, what your notes are. I'd love for you guys to share in the chat roll what's 1, 2, or 3 things that you're looking to learn today. When it comes to note investing, what are things that you're unsure of or things that you're scared of? I'll tell you this, you don't need to have $5, $10, $15 million to buy notes. We've got plenty of people that have bought notes for 10, 15, 20 grand. It may not be the biggest, like, hey, I'm going to retire on it, but it can be a good return for your IRA, your self-directed IRA account, whatever it might be, your Coverdale account if you got kids. I know, Sandra, you're looking to put some money to work through, I think, your self-directed IRA or your wife's IRA. Great way to get started by buying some notes. I mean, I've bought notes anywhere from $7 up to over $1 million. All right. So keep that in mind. We'll talk about how to get started. That's why we're here. Great. Thank you for asking that, Adam. But like I said, encourage you to network with us. Connect with me on LinkedIn, connect with me on the socials. And then I'll also feel free to book a call with me, ladies and gentlemen. You can always jump on and go to talkwithscottcarson.com. That's talkwithscottcarson.com. We're here to help you. I'd love to talk with each and every one of you this week. I'm home this week, Monday through Friday. You can book a call my time on my schedule, and we can visit and help you get rock and roll. If you're looking to get started beyond this class, we'll share with you the best ways. Love to find out what your goals and dreams and long-term stuff are. So we also have a Facebook group. You know, Facebook groups kind of can be more active sometimes now and then. I think there's about 1,000 people in there. Note Nation, it is a good group for networking. If you need something, find another note investors, note buyers, and feel free to go ahead and join that group. It doesn't cost anything, no membership costs or stuff like that, but encourage you to network and others that are in that group. All right. There are other resources. Let's talk about some free resources for you guys to take advantage of. Our Facebook group, like I said, about 1,000 members. Our Note Night in America webinars. We've been doing a Note Night in America webinar for over 13 years now. Maybe it's closer to 14 years now that I think about it. We've been kind of hit and miss this year. I'm not gonna lie. We've had some live ones and then pre-recorded ones. We do have a live one upcoming, I think this next week or the following week. But if you go to notenightinamerica.com and register once, guess what? You'll be registered for all of them. You can join in or catch the replays on the following day there for you as well. Our YouTube channel, we talked about this, going to weclosenotes.tv. You can subscribe to the channel. Like I said, we have the #1 YouTube channel for note investing out there, far and above and beyond anybody else out there that's in the investment space. And like I said, there's my link to book a call with me at talkwithscottcarson.com. The next steps, once you get through this class, like I said, this is a great kind of dip your toe in the water, get the ball rolling. Then you probably may want to think about taking our 3-day workshop that we host once a quarter. Our next virtual note buying workshop, or Note Buying for Dummies, is in June, in 2 weeks. So something to keep in mind for you guys there. If you want to take this next level, you can get signed up and start learning more about the in-depth of it. We do have a monthly membership for $97 a month. That's probably the best bang for the buck in the note industry. We'll talk more about that later on. We will be hosting a note camp, a mid-year, doing it in August this year. Once we get through the June class, we'll start the marketing for that, and we're excited to bring that back. We didn't do one last year, but we will be doing it again this year. And then, of course, we do have one-on-one coaching if that's something that you want to dive into. But this is a great way to see if we're a fit, see if you like how I teach. If you like me, great. If you don't, hey, no biggie, no harm, no foul. We still part as friends, and you'll learn something to help you on your investing career. What I'd like for you to do right now, ladies and gentlemen, is type in the chat roll. Tell us about your experience. Hey, I've been a real estate investor for 20 years focused on rentals, or I'm brand new to investing, or I've been a private money lender and I'm looking to buy more for my portfolio, or I'm brand new, or I've been a wholesaler, whatever it might be. Tell us a little bit about yourself in the chat roll so I have a bit of an idea on your experience. Let's see, we've got some new folks that have joined us this morning. Hey, Barbara, good to see you. Hey, EW. Hey, Forrest, how's it going, buddy? Hey, Karen. Kevin, Parnell, good to see you. Oh, great. We got some new folks joining us this morning. Andre, I don't know if I mentioned you, but type that in the chat roll. Howdy, howdy, howdy. But let us know what your experience is. Like, Forrest, you're a realtor. Hey, you might want to put in there, I'm a realtor in Central Texas. I know that you've structured some note deals for some of your clients selling some acreage, which is great. But let everybody know a little bit more about your experience. Like I said, feel free to share your LinkedIn profile URL. That's, if you don't have a LinkedIn profile, you need to go get one. It's the 21st century, and Scotty's giving her all she's got to pull you in to the light of the new century, ladies and gentlemen. Many of you have to quit marketing like it's the dark ages or it's the 20th century. We're in the 21st century. You got to start embracing some of these things, ladies and gentlemen. And that's the one thing that you'll find. Well, that's one of the one things that you'll find that separates me from a lot of other folks out there is I understand the power of marketing. You can raise a lot of capital and find a lot more deals if you embrace the marketing. Doesn't mean you need to be me, but you do need to advance your marketing. Most people aren't doing anything, and that's why you're not having any type of success, or you're having limited success by just trying to do one little thing. Well, doing the bare minimums never got anybody further along. So my goal is to help you take your business to the next level. Adam is a Ron LeGrand master student getting back in the game with notes. Adam, wow, that's funny. Not in a bad way. I'll talk more about that in a second here. Andre, new investor, have a little bit training on performing notes. Okay, cool. Let's see here. Kevin, Crooks Fix and Flip, looking for an easier way. Yep, I can understand that. So Adam Cortez, Ron LeGrand, big fan of Ron LeGrand. Actually, years ago, was on the Ron LeGrand circuit with Bob Leonetti and Jimmy Kale. That's who my mentors were. That's who taught me the note business years ago about creating owner finance notes, selling up the closing table, structuring that stuff. I mean, I traveled with Ron LeGrand's group for, I don't know, 3-4 years, not only on the investor side by working with Bob and Jimmy, but also we were doing with the mortgage company that I worked with, going with my buddy Boyd Pops. We did a lot of mortgages for Ron's students. Ron's investors back in the day. So funny you say that, but from 2004 to 2008, I was basically every other weekend on the road to a Ron LeGrand event and learned a lot from him, attended a lot of his classes, and took what I learned from him and applied it into my investing. So glad to have you here. I don't know when you were part of that master class stuff, but hey, it's always great to see somebody with some common roots. Let's see here. Andre, you've had a little bit of training on performing notes. If you mind me asking who you took to learn on the performing notes side, always glad to hear. Parnell, see here, says, hey, I've been in and out of real estate for a while. I'm looking to learn about non-performing commercial notes. Okay. Karen says, I buy multifamily in Virginia, South Carolina, North Carolina, and Georgia. Okay, but I guess you're here for notes though, Karen. Barbara, I'm a realtor in Central Florida. Have been investing in home flips, my self-directed IRA since 2010. Awesome. I'm looking to learn about buying notes and purchasing notes. Okay, good stuff. Good stuff. Thanks so much for you guys sharing. That is great. Let's see here. Yes, here for notes. Well, here's the thing too, Karen. I didn't say minute, but we're already seeing a lot of distressed notes in the multifamily space. All right. And we all know that a lot of people got in and bought a lot of multifamily apartments, and their whole goal was in 3 years to refinance out. Well, we know that refinance option is no longer around. It's gone the way of the dodo bird. So you're seeing really a lot of apartments that are getting foreclosed on. And we've been highlighting a few with some daily videos or little short deal videos talking about some assets. And if that's an aspect of what you're looking for, there's an opportunity if you've got some money to take some of those down, because you got to have cash to buy the notes aspect of things. Sometimes the banks will finance stuff, but most of these things, the banks want to be refinanced out of that mortgage on the multifamily. But we're glad to have you all here. Fix and flip investing, I get it. It's been difficult to find a deal. I like the fact that I can buy a note, rehab the borrower, or not rehab the borrower, and I know I'm going to either make money at the foreclosure or I'm going to start making money immediately by the borrower starting to pay monthly on a regular basis. And that regenerates cash flow. And if I want to sell that asset in a couple of years, I can, and make an even bigger chunk because I'm buying the asset at a big discount. So good stuff. Sandra, that's right. You are a real estate broker out of Miami, Florida. Thank you for sharing your link. Good stuff. All right, let's move on here and get rock and rolling into the different types of notes that we'll be discussing and kind of going from there in just a second, okay? All right, note weekend, we're going to type about the different types of notes that you'll see, the different types of notes that I believe are worth your time to pursue. And with anything, it's all about what you focus on. Can we agree to that, ladies and gentlemen? It's all about what you market to, what you put your energy into it. I mean, if you're big in a multifamily and that's all you're doing is multifamily stuff, it's going to be harder to find your notes. You got to spend some time on your business or other things to make things. Now, I don't want you to be a jack of all trades and a master of none. That's the one thing I dislike about real estate clubs, is they often focus on all these different types of deals, but there's no action to go out and do it. I mean, it's great to be educated. It's great to have a master's in real estate investing, but if you're not being focused and closing deals, it's really a waste of time and waste of energy. That's why we've niched down very long ago, found the value that the riches are in the niches, and picked this niche. But the different types of notes are different variables to some of these. The market has changed since I started, and we'll talk a little about that here. But the different types of notes that are available for you to buy is what we'll cover in this session. Now, notes fall into two categories. You have institutional and non-institutional debt. Now, what does that mean? Institutional means it's not institutionalized. No, basically it means it was originated by a bank, a lender, some sort of institution, okay? Non-institutional debt is owner finance stuff that's basically, like I'll give you an example, like if Forrest is working with a borrower selling the house and they create an owner finance to sell owner financing, that would be a non-institutional debt. If you're buying a contract for deed, that's a non-institutional debt, but it can be created by an entity, of course. We buy primarily institutional debt direct from banks, lenders. We do buy contract for deeds. They're not big here in Texas, but we do see them in other places. And occasionally we'll buy owner finance notes. Occasionally we'll do. The reason we've gone and focused on the institutional side is once you get into a source, it's much easier to get stuff sent to you on a regular basis that you can cherry pick from. Okay. That's not saying you can't find non-institutional debt makes sense. It's just it's a harder process to go that route to try to find just owner finance notes. I had a guy reach out to me, oh, I'm just targeting owner finance notes. I'm like, well, what's your success? Well, I've sent out 500 postcards. I've gotten 5 phone calls and nobody sold anything. So, well, how much does that cost you? Well, it cost me about $1 a letter. I'm like, okay, so about $500. He's like, yeah. I said, listen, man, if you could jump on LinkedIn and you type in a few terms and you hired a VA for $5 and that's $100, I guarantee you they'd find you a lot of deals that you start looking. Heck, you can go to a few websites and start looking at deals right now. You know what I mean? Parnell, thank you for sharing your link. Awesome. Thank you. So institutional debt and non-institutional debt. Let's talk about some of the different things. Now, you have residential first liens that are performing. This falls in both categories. And by performing, that means the borrower is paying on time. Pretty simple, whether it's they've paid on time for 30 days or 30 years, whatever. Performing notes is one way to go. Now, what's the thing about this? If you're looking for performing notes, okay, you're probably not going to buy a performing note directly from a bank. Banks aren't going to sell a performing note off most of the time on a one-off basis on a residential deal. They'd rather sell that in bulk. Like I had somebody reach out to me, bank out of California, 1,500 notes performing. They wanted par, basically right at par, 99.5%. Like there's no way to make any money on that. No thanks. Okay. Now you can buy performing notes from this is the one niche that you're probably gonna find. You can buy performing notes from owner finance buyers. It just takes a lot of work on the front side. And I'll get to what performing is. This is where it's basically been paying on time nonstop. Okay. Non-performing. Residential first liens, we're talking primarily about residential today. We'll dive in a little bit in the commercial side. But non-performing, this is what you can buy from owner finance, institutional, pretty easy to find non-performing notes if you know where to look. What I like about this is you should be getting these at a substantial discount depending on where they're at, how far behind they are, what state they're in, and the value of the property versus what's owned on the note. You can also buy junior liens, second liens, both performing and non-performing. These are harder to find than your first liens. The reason they're harder to find is A, there's a lot less created, a lot less originated on the second lien space. They're also a riskier position to be in. I don't buy seconds. I mean, I have bought some seconds, but they were always the seconds that were behind my first. And I bought them at a very cheap price because I was going to foreclose them out. And seconds are overpriced right now too. With all the appreciation that's taken place the last few years, those seconds are fully encumbered. So people aren't selling them at 5 and 10 cents on the dollar like they used to. I get people like, oh, I got 50 grand, I buy a portfolio of seconds. You might buy one. And they're like, what do you mean? I was like, you have to realize the market's changed since 2008. You can't be taking a class and a manual from then and applying it in today's world. This is why we do this. This is why we teach classes on a regular basis, because the market's changing. Pricing is changing. Expectations are changing. Can we agree to that, ladies and gentlemen? Yeah, it's just different. You got to understand the market. I had a guy reach out to me the other day. He's like, oh, I got your manual from 8 years ago. I'm like, well, some of it's still going to be good, but a lot of it's going to be outdated. I'll just stick with that. Okay, fine. Commercial first liens. You can also get commercials, junior liens. I wouldn't buy a junior lien on a commercial property right now at all. You can buy commercial first liens that are performing, paying on time. Also, commercial first liens that are non-performing. Okay, no, you don't. I mean, commercial is a bigger space. You're going to need some money on either of these, whether it's yours or other people's money. But there's also a lot of non-performing commercial liens out there. Okay, the further in default they are, further behind they are, the further they've exceeded their maturity date and not refinanced out, the bigger the discount the lender should be taking to get it off their books. Okay. Owner finance notes. This is, performing and non-performing. We talked about that briefly. Contract for deeds. This is basically like a land contract. You'll see that you can buy those performing and non-performing. We still buy a lot of those. You don't see as many of those as there once was because value's gone up quite a bit, but we saw a lot of contract for deeds back in 2008 to 2014, these low value properties, these foreclosures that HUD took back. You had big firms like Harbor Portfolio, who bought these by the thousands and just basically owner finance them on a land contract. If you didn't pay, you got evicted. Bring 500 or $1,000, you're on a 30-year mortgage at 9.9%. Get into a house, cheaper than rent. Okay. If you didn't pay, after 90 days, we evict, foreclose in a few states, and then do it all over again. So those are pretty good. We bought a lot of those, spent a lot of good money on contract for deeds. A little bit different now, but still a lot of opportunity out there. Okay. You'll see some lease options available for sale. I don't spend a lot of time on lease options because it's just a tenant, and a lot of you can't do a lease option here in Texas beyond 180 days legal. I like actually owning and being in a secured position of either owning the first lien, or on the deed, being on the deed if I buy a contract for deed. Okay. I only buy 99.9% of the time first lien. That's all I buy. Okay. And 95% of the time it's institutional debt. We've bought owner finance notes, but oftentimes the seller can't take the discount that I'm willing to give them. And oftentimes the owner finance note is written in a spot it's really unmarketable. Like I'm always surprised when sellers will give like a 2% interest rate on owner finance notes. Well, you can't market that right now. It's not, with interest rates being at 7%, it just doesn't make a lot of sense. So always, if you're thinking about owner financing, it's always best to run it by somebody who's a note buyer to tell you how to structure that deal better off. Now, look, I love buying an owner financing. If I can get favorable terms by getting the seller to agree to owner financing at a 4 or 5% interest rate, by all means, do it. We've done that. We've bought on 0% interest rate because the seller was motivated to move it, and they needed to get that payment off their books or have somebody cover their payment, so we took it over. We've also modified some of our loans to 0% interest for some of our borrowers to help them pay that asset off faster, and it still was a good deal for us. All right. So where should you focus? Okay. Where should you spend your time focused on in today's market? Pretty simple. People look at two things most of the time: cash flow versus the property. Look, if you're getting into the note business to acquire more property, don't. Okay. You always got to look at the aspect of this, a cash flow basis. That's what banks make loans for, is the cash flow basis. You are wearing a banker's hat when you become a note investor. Focus on the cash flow side of that. All right. Yes, it is important to know the property values. I'm not talking about it. Will you take some property back at some point? Will you foreclose? Yes. There's no guarantee, though, you're going to end up with a property by foreclosing, unless it's some specific situations. We'll get that later on. But focus on cash flow first. Focus on ROI, your return on investment, and your return on time. I'll give you a great example. We got a deal in that we made an offer on. It was on a 5-acre mini farm up outside of Anderson, Indiana, worth about 95. It was vacant. The borrower had passed away, but they deeded it over to a neighbor. Hadn't paid in 4 years. They only owed like 25. We made an offer at 15, and it was accepted. But they were only making 100. The payment was only $149 a month. Okay. When we made that offer, it was non-performing, with the idea that we were going to foreclose and either A, get paid in full at the auction, or B, if nobody bought it at auction, now we take the asset back and we own it. And this is something that would have been good. But our biggest goal on this one is not the cash flow on this one. $149 a month on a $15,000 isn't worth our time. Well, our offer is accepted, but guess what? The borrowers came to the table and reinstated the loan to the previous seller, and now they're only paying like $200 a month. They modified the payment a little bit. Still not worth it. So the return on investment for us on that deal is not good. Moving on to something else. Okay. Inventory too. If you're looking for stuff in specific states that's not having a lot of inventory, it may not be worth your time. Like, I'll give you an example. I'm in Austin, Texas. I love the Lone Star State. I love Texas. Okay. This Minnesota boy that came to Texas, a young guy, I would say more Texas than anything else. If I just focus on Texas assets, I would probably have gone broke. If I'd focused just on Austin assets, I would have gone bankrupt a long time ago, because Austin, very competitive market, Texas, very short foreclosure time frame. And so when I started getting these listings, yes, I would look at anything in Texas, but it's often because of the faster foreclosure process and the big demand here. Banks sell this stuff a little bit more expensive at higher price. So I put my notes to look at different states. And that's why I buy in about 20 to 30 states. I buy in Texas if I see something. I love Austin, but I rarely see anything in Austin that's going to make sense for me. If you're in California looking for just California assets, you need to expand your horizon and go somewhere else. Okay. It doesn't say that you won't see some stuff in Texas. You can't do it. But if you just set your sights on that limited target, you're going to have limited opportunities. I always say look at 3 to 5 states to start off with. Don't just go for the non-judicial or the fastest foreclosure states. Everybody wants to do that. If you find a deal in Ohio, which can take you 9 months to foreclose, then great. If the borrower's in it and wanting to make some payments and you can buy it at a good price, be good ROI, great. You have to set your mind up not to be like 90 days in and out of it. These are longer term deals of usually 12, 24, 36 months. Good yields. All right. Keep that in mind. If you're just trying to do quick fix and flip, this is not the business for you. Okay. I get phone calls all the time too, like, oh, I just want to buy apartment units that are 100 units or less. Well, so does everybody else. Okay. Apartments have been one of the most overpriced asset class for years. That's not saying you won't find it, but you're not going to get it at 10 cents on the dollar. All right. You're going to be expecting to come in at probably 60, 70 cents on the dollar. And if that makes sense, great. If it doesn't, then move on to something else. Plus, if you're buying like $1 million note in California, well, you could buy $20,000, $50,000 properties at other places and have your risk diversified, have a higher yield. There's a lot of things to customizing your business model with this, but these are important things to keep in mind. Okay. Pricing, we talked about this. Pricing will vary. I don't buy anything on the West Coast because they're just smoking crack out there. They still want like 90, 95 cents of the dollar for non-performing stuff. There has been some things, some bigger commercial buildings that have sold at bigger discounts, sizable discounts. In LA recently, San Francisco stuff. I wouldn't buy in either one of those states. I don't buy California in the communist state of California. It takes forever to foreclose and it's not worth it. Better deals. I like to buy in landlord-friendly states, lender-friendly states. Okay. Time. You don't need to put in a 40-hour work week. People ask me that all the time. How much time is this going to take to add into it? I'm going to say if you dedicate 5 to 10 hours a week, okay, and I'm serious, 5 to 10 hours a week, an hour on Tuesday, Wednesday, Thursday, and an hour or two on Friday, Saturday, Sunday. Probably not Friday. It's time with your family, and most of the banks are closed, obviously. But a couple hours on the weekend, a couple hours during the week, you can get started by making offers, starting your marketing. The two things go hand in hand. You don't wait to market for deals and you get all your ducks in a row. That's a waste of time. But start your business, start doing things on a regular basis. We'll show you that a little bit further. Okay. And one of the most valuable things you can do is to go watch this video. Oh, hang on here. Let me do this. Hang on one second. I'm going to go here and share this link in the chat roll. It's one of the favorite videos that people like to watch. It's basically how to make 100K in 12 months. This might be the older link to one of the previous ones, but hey, it's still a good video. And let me go over here, type this in the chat roll for you. Everyone. There we go. Go watch it. It's kind of our game plan for how we buy deals, our business model for building cash flow, for creating a 6-figure income in 12 to 24 months of passive income. All right. Not using your own money, not making $1 million purchases, but $50,000 assets, $100,000 assets, buying 1, 2 of those a month. You can do it and really set yourself up in the long run to say, hey, take this job and shove it or basically retire if you want to do that. But how to build a 6-figure cash flow business by going to that link. Okay. You can also go to our YouTube channel and type in 100K in 12 months, and that should pop up as well for you. A couple of different of those videos we've done for you. We always usually update it and like to share that because the market's changing, ladies and gentlemen. But we got to have a game plan, and that's been a really great game plan for a lot of our coaching students to take that model and make things happen. Okay. Now, of course, foreclosure timeframes will also have a huge impact on your note business. This is why we avoid the longest foreclosure timeframes. Okay, there is judicial foreclosures. That means going through, you have to have an attorney, file a lawsuit, and go through the judicial court system to foreclose. Most of the time, the fastest you can get through that is 6 months, probably 9 months on average. Some states are over a year. Okay. Some states are 2 to 3 years, and we don't buy in the longest foreclosure states. Okay. It's going to basically cost you at least usually $3,500 to foreclose, if not up to 10. In Florida, it's about a 12 to 18-month process, depending on what's going on with that borrower. Okay. You can often get them in a little bit cheaper price point if it's in a longer foreclosure state. I don't buy in New York. It's a 3-year foreclosure process. I don't buy in New Jersey. That could be a 2-year foreclosure process, except for vacant properties. They've got a 6-month expedited foreclosure for vacant properties in New Jersey. It's not so bad. But those I don't buy in Puerto Rico. Takes you about 3 years to foreclose there as well. Yes, you can buy notes from Puerto Rico. You can also buy them from the U.S. Virgin Islands. We'll see them every once in a while. Pop-up takes a couple years to foreclose there. Okay, but there's still plenty of great notes to buy in other places. Now, I don't like Chicago. No offense to our friend from Illinois. Illinois is about a year-long process. Chicago, my gosh, is the most corrupt system out there. I call it Crook County. So avoid Crook County or Cook County, Illinois. Doesn't mean you can't buy something in Lake County, DuPage County, or other places around Illinois. You can. Still can take you about a year to foreclose. Ohio is about 9 months. I'm not going to go into a state-by-state basis. That's something for you guys to take a look at. Very easy to Google what's the foreclosure time frame in blank state. Okay. Non-judicial foreclosures. These are fast foreclosures where all you basically need to do is file a notice of default. In judicial states, it's called the list pendants to file that foreclosure starting process or that the borrower is in default. Some states, like Texas here, you don't file a notice of default. It's just basically if they're late in more than 90 days, you start that foreclosure process, you can foreclose in 21 days, okay? Shorter time frame, 21 to usually about 120 days. They're less expensive, 1,000 to 2,000 to foreclose. A lot of states west of the Mississippi, but since it has a faster foreclosure time frame, you're going to pay a little bit more. Like Georgia and Texas, the two fastest. Georgia's 30 days, Texas is 21 days. You're often going to have to pay at 70, maybe 80% of the debt, depending on equity, because it is such a faster foreclosure state in today's world. Just is what it is. All right. So when I'm getting started, I always tell folks, pick a couple judicial states, a couple non-judicial states, and they'll give you an opportunity. Like if you're looking at stuff like I would look at, if you really want to dive into stuff, look at Ohio, that's judicial, Michigan, non-judicial, Indiana, judicial, but it's usually relatively faster. Missouri is non-judicial, and then pick another state. If you live in Texas, don't make Texas one of your top 5, make Texas the cherry on top. Okay. Florida. If you're down in Florida, there's a lot down there. You just got to expect to be into the deal a little bit longer to get things done. Doesn't mean if you're trying to buy a note to get it modified or reinstated, it can happen faster than that, but it can drag out because of foreclosure timeframes. Licensing requirements. Do I need a license to buy notes? And the answer to that is yes and no. It depends. Okay. If you're buying in like California, Washington, Oregon, they want you to have a specific license for that. I don't buy in those states. It's not worth it. Big pain in the ass, so you don't need it for that. Georgia wants you to have a mortgage broker's license unless you're buying in your self-directed IRA. That's the exception, okay? Most states want you to have a debt collector's license of some sort, and most of the time that licensing requirement is completed when you hire a servicer that's licensed to collect debt in that state. So if your servicer is a licensed debt collector, that usually solves you needing one. There's a few states that are different, like Illinois does want you to get a separate state license for collect debt. That's about $750. It's good for about 2 years. Won't stop you from buying. You got to get that going before you foreclose, though. Some other states have some other trickiness, like Louisville or Kentucky wants you to have a personal bond if you're done in your personal name of $500,000. If you're an entity, it's $1 million bond. I don't buy there. There's only really 2 cities in Kentucky that interest me: Louisville and Lexington. But there's other, but you can actually buy real estate cheaper there instead of going through those license requirements. Massachusetts has a weird licensing requirement. I don't buy there. Let's see what else is any weird other license. Not really, but like I said, if your servicer is licensed to collect in that state, it usually solves it 75-80% of the time. Okay. Ohio, that's the thing. If you're going to buy junior liens, you got to have a separate license to buy junior liens. I don't buy in Ohio. Okay. Let's see. Oh yeah, Maryland does want you to have a specific different license. Not that big a deal. That won't stop you from buying. And we already talked about the Georgia requirements. Okay. Now this can change over time. Some states are trying to enact laws to make it a little bit more difficult to buy notes. Okay. So if you have a specific thing about a specific state, talk to your local legal team, talk to your local attorneys and stuff like that. So I'm assuming there's still a strategy to make good money paying a bit more for deals in these faster foreclosure states. Yes, if you're, of course, Parnell. if the numbers make sense. Okay. So yes, it's all about velocity capital. So I'll give you an example. Like in Texas here, if I can foreclose in 21 days, well, and that means if there's equity above what I'm buying the note for, and I'm going to not sell at the auction, or if I do sell at auction and I make 10 grand on a $60,000 purchase price, 10 grand on 60 in less than 6 months, that's a pretty good yield. Can we agree to that? Yes. If I don't sell at the auction, I take the asset back and it's worth 100. Well, yes, then I can turn around and fix that property up and sell it. So yes, it's all about the numbers. Okay, all about looking at numbers. Don't fall into the trap of OTSC. Oh, that's so cute. Okay, the numbers have to make sense on it. And yes, if you can vote speed, it's all about days on market. If you take an asset back, or is it in the foreclosure process and what's owed versus what am I buying? I'll give you an example. When there is equity in a deal, and by equity I mean there's value of the property above what's owed, the legal balance. So let's say you got a $200,000 property, legal balance is $150,000. Okay, there's $50,000 in equity that the borrower has. You don't own that equity. You're not the property owner. You're only a bank. You're only entitled to that $150,000. Well, since there's often equity above in those equity deals, banks will want you to come in, or sellers want you to come somewhere around 80 to 90 cents of the legal balance. Well, if they want me to pay 90 cents of the dollar of 150, it means I'm paying 135. Now, in Texas, that might still be a deal to make 5 or 10 grand on. And that's too skinny a deal for me, right? Now, if it doesn't sell at the auction, now I own the property. Now it makes sense of that stuff. But for me, I've got to make at least 15 to 20 grand at the foreclosure auction to make it worthwhile my time in a faster foreclosure state. I wouldn't do that in Florida to only make 15 to 20 grand because it's a longer foreclosure process. I'm going to have some money costs along the way. All right. Is that starting to make sense for you a little bit there? Plus, if it's occupied, I want to make sure if they start paying their monthly payment time, the yield is going to make sense for me either way. If I'm using my own money, I'm going to make at least 10 to 12% on the reinstatement or the payments. Or if I'm using other people's money, I'm going to need to make 16 to 18% if I'm paying somebody 8 so that I get 8. So absolutely makes sense for it. Good. So it all depends on individuals on the deal. Okay. For the one in Indiana, yes, I was paying roughly, I was only going to be a $9,000 profit. Buy the 15, they owe 24, foreclosed. They were basically within 90 days of the foreclosure auction. I was going to be using my own money out of my IRA. I didn't mind letting that ride to make 5 grand on a $15,000 or 9 grand on a $15,000 investment. That's a pretty good deal for my IRA. It doesn't make sense for me to tie that money up in a performing note though at $200 a month. After my servicing costs, I'm going to yield 165. There's better things to do with that IRA. Okay. You're going to have a loan servicing company doing a lot of the collections, sending out the statements to you. That's one of the most important things. The servicing company adds value. It's also a great way for you to see that they're collecting on your behalf or collecting on the seller's behalf. One of the biggest mistakes I see in owner finance sellers is that they don't have a third-party servicing company collecting. So it can cost you $15 to $25 a month to have a third-party collect. Make sure everything's documented. It's much better than getting canceled checks and hoping that the seller, Billy Bob, keeps track of everything. Okay. It's one of the reasons I don't buy a lot of owner finance notes. It's the paperwork isn't Dodd-Frank compliant. Servicing companies will make sure it's Dodd-Frank compliant. They're going to make sure it's on track. You can be able to download it, look at everything in one spot, which makes it so much easier to buy or sell a note. Okay. Also, talk with your servicing company. We use a couple of different servicing companies, depending on, they're not all licensed in all 50 states. They don't need to be if they're not collecting anything. We use Covey Financial out of San Antonio. They're good if you're doing 20, 30 deals. They usually want you to have a little bit bigger portfolio. They don't usually want to deal with a one-off investor. Allied Servicing out of Washington State is probably your best bet for a one-off getting started, that or Madison Management. I would not go with FCI Exchange. FCI Exchange is horrible with small investors. Okay. It just is what it is. Okay. And depending on where you're buying it, there's some services I would recommend, services I would recommend. Essence Servicing, while they will do a one-off note, they're going to be the most expensive out there, and I wouldn't necessarily keep it with Essence Servicing. You could go with Land Home. They usually want you to have a little bit more portfolio. Loan Servicing Center, there's a bunch of servicing companies out there, 200 plus servicing companies to choose from, and there's usually just a few that I would recommend as you're starting off. Okay. Now, what's available in today's market? Not reperforming notes. This is something we didn't talk about. This is a reperforming note is a non-performing note that the investor has gotten the borrower back on track. Okay. This is a valuable niche. Okay. We'll buy and reperforming all day because here, I'll give you an example. A borrower hasn't paid in 6 months. The note buyer buys that note, say at 50 cents on the dollar. Okay. They reached out to the borrower, said, listen, do you want to stay or you don't want to go? The borrower's like, I want to stay, but I can't bring up the full 6 months of payments. So, well, we'll work with you. So the borrower starts paying on time and pays on time for 12 months or 6 months with a big payment to get caught up. Okay. That's considered a reperforming out. Now that seller, if I'm that investor and I bought it at 50 and I got them back on track for at least 6 months with a big chunk, or they stayed on time for 12 months through a third-party servicer, I could turn around and sell that note at 80, 85, 90 cents on the dollar to Wall Street, sell it at 80, 85 to other investors. It's technically a performing note with a third-party servicer. That could be an 8 to 12% or more return to the new note buyer. Now, I bought it at 50. If I'm selling at 85 and I got a year cash flow, I'm sitting there making 40% roughly. That's a pretty good ROI. So you can buy reperforming notes from investors. There's a few places to go. You can target note investors on LinkedIn, other places too. Yeah, because what happens is a lot of times note investors will buy non-performing, they'll get reperforming like the cash flow, but they may need to sell some stuff off to go buy new stuff. That's what often happens. We'll hold a non-performing note for 2 to 3 years, get it reperforming for that cash flow, and after a period of time, we'll cash out our investors by selling the note off or refinance them out. Okay, non-performing notes, we know that you're seeing an increase in this. Yes, default rates on first liens are basically at 2 to 3%, but there's still a lot being created. There's still a lot out there for you to take a look at, not only on the residential, but also in the commercial side. Definitely small balance commercials struggling direct from banks. You will see some contract for deeds available. Definitely non-performing commercial notes. Really, the sub 5 million is where you guys are probably going to play the most in. And that's okay. There's more of that than the big stuff. A lot of the small regional banks have a lot of the small balance commercial that they need off their books. Okay. Definitely an opportunity for you. Old notes on platforms. You'll see stuff like on Paper Stack or a few others out there that have been dragging around. Yeah, you can bid on that stuff or you can look at stuff. I choose not to buy that crap. I'd rather look at stuff that's fresh and go out and target sellers that I can get stuff sent to me that's fresh. So fresh and so clean. New deal flow versus the old picked over shit. You can agree to that, right? And you can also look at newly originated owner finance notes. Some people will sell these. You got to make sure, with interest rates being where they're at, if it's somebody's got a low interest rate, below 8%, you're going to take a discount. Now, you can also do partials. I'm not going to spend any time on partials. Partials, the most over exaggerated aspect in the business. Yes, can somebody buy 5 years of payments? Yes, they can. It doesn't happen that often. But you're not going to buy a partial payment from an institutional loan. Okay, let's put it that way. You're going to only buy partial payments from an owner finance note for the most part. Okay, still gonna make some money on that, but I'd rather deal in where I get the biggest honey holes, which are non-performing from banks and institutions. Okay, you have to have in this business, ladies and gentlemen, if you're coming from the fix and flip mindset, you got to take that hat off and put on your banker's cap. The banker's mindset is going to be different. And if you try to merge the two together, you're going to be overcomplicated, confused, and overpaying for assets. I'll give you an example. You're buying the note, not the property. You are buying the note, not the property. You're only entitled to technically what the note is until you go to foreclosure. If it doesn't sell, then you get the property back, or you get the borrower to deed the property over to you. Okay. Quit chasing equity. You know, we as real estate investors coming from the fix and flip, oh, we can buy this at a discount. There's all this equity. I'm going to have this equity when I buy the property. Yeah, that's when you buy the property. You don't, the equity technically belongs to the borrower unless they give up that up. Okay. You want to streamline your product's focus. You want to pick, you know, like I'll give you an example. I like looking at 3-bedroom, 2 baths for the most part, you know, around 1,500 square foot, built after, 1980. I don't get into the weird equestrian farms. Yes, did I look at a 5-acre small farm in Anderson, Indiana? Yes, because I could get it at a price, and I'm looking for land for myself. Okay, that's the thing that I'm looking at. That's for me. That's different. But my basic stuff that I'm doing, I can look at all day long, like a 3-bedroom, 2-bath. I'll look at 2-2 condos. I'll look at 2-2s as well. Stuff that makes sense, usually in that $100,000 to $500,000 range for the most part. Okay, that's where I want my investments to be. I avoid the shiny objects, the squirrel syndromes. When you start looking at weird stuff outside of your buy box, it's going to take away your focus and you're going to waste time. That doesn't make any sense for you. Okay, so if it's a unique property, I get somebody calling me, oh, I got this unique property. I'm like, I'm not interested. Okay, just not interested. Yeah, Forest, you still haven't sold the 26 acres east of the Austin MSA yet? Aren't they behind on their taxes still? Then I'll email you over an offer. You're probably not going to like it, but I'll email you over an offer. Something you can present to your sellers on that. Forest, that's funny, man. I thought you'd sell it, but I guess not. I guess the market's changing. Yeah. Email me on Monday. Shoot me a message on Monday to remind me. All right. Here's the thing. When you're buying notes, you're buying the note. You're looking for the cash flow. Your cash flow should be your number one priority, with taking back the real estate to sell it as your second, and then doing a fix and flip as your second or third option. Okay. I like to buy clean assets. I don't necessarily want to buy assets that have to put a lot of work into it. It just doesn't make sense. I'll give you an example. Right now, I'm evaluating 8 assets down in Florida: West Palm Beach, Miami, Fort Lauderdale, Cape Coral area. Okay. These are vacant assets. Okay. They're reverse mortgages. The borrowers are deceased. Yes, we see reverse mortgages. It's not a cash flow play because I'm not going to get the borrower to come back and start paying from beyond the grave, right? But I'm looking to buy these cheap enough, and they want to be in good enough condition. They're going to buy them cheaper by buying the note, finishing the foreclosure, and either selling the auction or doing light upkeep to these. Okay. This makes sense because I'm getting these at a bigger discount, because the bank's got a lot of these in the inventory they want to move off their books. But these are going to be 6-month deals or less for the most part. I'm looking at those because we see it at a bigger discount. I also like looking at the stuff that I can get reperforming. Like I'm looking at this one in Elkhart, Indiana. It's occupied. Borrower hadn't paid in a year. If I can buy it, my goal is to get them to reinstate, start paying on time. If they don't reinstate, then I'm going to foreclose, and it's still going to be a good deal. But the yield on that deal, as a cash flow basis, is going to be good. And I want to build more of those. I want to have something that's bringing in $250 a month in cash flow or greater to me. That's my cut after paying my investors. I prefer 375 or more, but that's what I want. Buying these small balance notes or buying notes that are going to return me a good cash flow, good yield to me, that I don't have any of my own money in the business in that aspect. Okay. And then I'll do occasional fix and flip, occasional take the asset back, foreclose, sell it. If I sell it at auction, guess what? I'm sitting pretty on those Florida ones. Okay. I'll make 50 grand each or more if I sell it to foreclosure auction. Now, if I do take it back, I'll make even more money, but I can't lose on that aspect of things. Okay. Does that make sense before we move on to session number 3? Any questions you want to talk about before we move on? All right, let's move on. I know I covered a lot there. All right, the next session we're going to talk about is how to find note sellers. The number one video on my YouTube channel this month was how to find note sellers. So we'll talk a little bit more about that. Is that there are a lot of sellers out there. It's actually easier to find them than you would expect. Okay. Places to find note sellers, or people have notes for sale. You can actually go to banks. You need to talk to the right person. We'll get more on that later on. Lending institutions, mortgage bankers, servicing companies, note conferences and conventions, LinkedIn, private sellers. You can actually go to the county clerk or the county recorder's office and actually look for assignment of mortgages that are filed to find who had a note and who sold it. So you find 2 people. Foreclosure lists will tell you who the bank is that you can reach out to, and or the attorney who's foreclosing. We did a whole finding deals webinar here at this link. Go check it out. bit.ly/finding note deals. Go through a whole lot of great things out there. We've found deals from all these sources and then some. Okay. Now, when it comes to contacting banks or lending institutions, there's specific departments that you want to talk to. Now, you're not going to call customer service and talk to loan servicing. They're not going to know what the hell you're talking about. They're going to tell you, no, we don't sell their loans. Most of the servicing for banks and lenders is outsourced by a third party. They're just there to service the loan, not to help you with it. That's why if you're contacting banks, you need to contact these 4 departments. You don't learn anything else from me this weekend. Learn this one thing, okay? Large institutions, their departments are called the Special Assets Department. So if you want to go to LinkedIn, type in Special Assets Manager, okay? Smaller banks, some REITs and stuff like that, they have something called a Secondary Marketing Department. Not the marketing department, secondary marketing, okay? Secondary Marketing Manager is a job title to take a look at, okay? Whole loan sales department. This is by REITs and insurance company. Look for whole loan traders, whole loan sales, okay? Even capital markets can often go by commercial stuff. Capital markets manager. Fourth one is the smaller banks, the smaller institutions, stuff like that, smaller regional banks. They'll have a chief credit risk officer or a secondary marketing or special assets. Just depends on the institution. These are the 4 names of departments at banks that you want to ask for. You can actually go to LinkedIn right now, type in special assets manager, secondary marketing manager, whole loan sales trader, chief credit risk officers. On LinkedIn, you'll find thousands and thousands and thousands of people that have that job title. And then what do? We send them a message. Hey, are you the right person that handles the note sales for ABC Bank or GMC, whatever it might be? I love to talk about if you've got anything on your books that you're looking to get rid of. Very simple. Other websites, you can go to laneguide.com. Not land guide, but laneguide.com. That's been around for years. Costs about $165 a year, maybe 180 now. I don't know. It kind of tracks who's bought who. It can often give you a lot of internal numbers and emails to asset managers at some of these banks. Bauer Financial, you've probably seen the saying that there's 65 to 85 banks that are technically upside down in their portfolio that are pending closing. Bauer Financial is a place to find that information. Bauer Financial will take the quarterly reports that banks and credit unions have to submit in to the FDIC, and they'll basically, you can look at that stuff there. Or what I do is I contact Bauer Financial and they send me a report once a quarter with the star rankings, and then basically those quarterly reports finalized down to a spreadsheet. What percentage of their portfolio is in default, what's between 30 and 89 days late, what's the balance of the portfolio, what percentage of this stuff is, what percentage of their multifamily stuff is in default, who's got defaulted stuff. It's a great resource. About $300 to $400. It depends on what you pull. I only pull it for banks that have 5 or more branches. Anything below 5 branches are really too small. And that's not saying they won't sell, but they're going to be very, very conservative on what they sell. They can't really take a big discount off of what they finance that property for. So the ones that have 5 or larger banks, they're the ones that are going to be, what would I say here? They're the ones that are going to have the most amount of opportunity for you and be a little bit more aggressive on their sales. The FDIC.gov, you can go there and check out any bank's quarterly report. They will also tell you what banks have gone out of business and any asset sales. In Texas, we have a very friendly state. You go to the Texas Savings and Mortgage Lending Department. You can actually go on there and ask for them to send you a list of all mortgage bankers doing business in Texas, or mortgage servicing companies that are doing business in Texas. That's a great place. They will send you a spreadsheet, names, phone numbers, and email addresses, especially in the mortgage bankers, mortgage servicing. They'll send it to you for your full mortgage company, anybody that's licensed in the state of Texas. But mortgage banker contacts, servicing contacts, that's a wealth of knowledge, a couple thousand emails right there for you to add to your database to start reaching out to, okay? And then there's other state licensing websites. Every state has a different department, kind of like California's Department of Real Estate. Illinois, I think it might be the Department of Insurance. It varies. Florida's, Department of Real Estate, stuff like that. If you reach out to these and ask for, I'd like a list of licensed mortgage bankers who are licensed to do business in Texas or Florida, wherever you're at. Mortgage bankers, not loan officer, but mortgage bankers, that can be a really good source to reach out to. And I like to take a list of contacts, put them in email, and drip market to them on a regular basis, okay? Scotsman Guide can also be beneficial on the commercial side. It's not so easy on the residential side. The scotsmanguide.com. It's Scotsman Guide with just 1 T, not 2 like my name. Free, been around for years. It used to become in this big magazine like ESPN, the magazine, once a month when I was a mortgage banker, mortgage broker. Now I just use them to kind of find some commercial portfolio sellers who are originating notes, holding for the portfolio as potential ways to buy their stuff off their books. Okay. You can also look at some platforms like paperstack.com is okay. Watermark Exchange really isn't around anymore, but occasionally Val will throw some stuff up on there. Essence Servicing doesn't have a platform, but you can register as a note buyer there, and they'll send you lists out. About once a month, they'll ask you to who's your coach, note coach. David Polio is the trader there. Deb Expert's kind of a newer platform. They'll have some stuff occasionally. Fixed Notes will have some stuff that's usually really crappy second and third liens, not really worth wasting your time on. On the commercial side, 10x or auction.com is the same platform. They'll have notes available for sale or auction that they're going through. Mission Capital is a bigger company with bigger portfolios. No Trader Exchange, I've never bought anything from them, but they'll say they'll have stuff available. And then DebtX is a big exchange that's going to require you to register for like a $500 to $1,000. Okay. Platforms are okay. I will use primarily PaperStack to get a list of sellers because they'll list who the seller is, and I'll contact the seller directly because they usually only have like one or two notes on that platform. But I know that if they've got one or two, they probably got a bigger portfolio behind them. Okay. In essence, we'll send stuff out pretty regularly on the weekly to monthly basis. But that's a great place to get started. Those are great places to start looking at stuff, start practicing your due diligence, evaluating them. You know, I don't buy much from platforms. I buy direct. I have banks that send me lists directly because we've made a contact. Like we just got that 188 direct from the seller. It used to be on a platform. Contacted me directly to buy some notes. And we made 10 offers. We got 8 accepted, and we know we're already going to kill a few of them already just because things have changed since we made our offer. But that's okay. That's a process. You have to expect to have only about a 10% closing ratio. Okay, so if you make 100 offers, that means you're probably going to get 10, 40, 50 accepted, and then you'll probably close on 10 of them because you'll kill the others off in due diligence, values, paperwork, other things that just don't make sense for you. Okay? Questions? Comments? Concerns? Now, we've talked briefly about what type of deals you can find, where to find them. I want to go through a little bit what you say, what not to say. Okay. We'll go through a lot more in depth during our 3-day workshop. We spend the first full day on finding deals, second day on the funding side, the marketing side, third day on the exit strategies and structuring deals. That's what we go through in our note buying for dummies workshop that we're hosting in 2 more weeks in June 21st to 23rd. I think I have the dates right. But that's where we're going to do a deeper dive into. We'll show you how to find contact banks. We'll actually walk you through that process of jumping on LinkedIn and going through it and sending messages and showing you how we actually market to find this stuff. But when you start reaching out to banks, there's things you want to say and things you sure as hell don't want to say. Okay. Remember, you're a note investor. You're only looking for the bank notes. Okay. What and what not to say when talking with asset managers. Okay. You're going to have a basic elevator pitch. One of the things that I did years ago, and I still use it to this day, was I created a 1 to 2 minute little short video pitch. And I have that saved. So when I email an asset manager, instead of just being an email, I'll include that video link where it's me talking. Hi, my name is Scott Carson. I've been an active note and real estate investor for over 20 years. I'd love to talk about what you have on your books as far as non-performing notes on residential commercial properties. I'm looking for first liens only on the residential side with values between 100 and $500,000. And then I'm also looking for small balance stuff below 5 million. If you've got something you're looking to get rid of, I'd love to take a look at it, see if we can create a win-win scenario and go from there. So it's kind of like that. You know, what do you have in your books you're looking to move this quarter or next? What do you have in your books you're looking to get rid of? This is when you get a hold of the right person. Like I said, don't contact the customer service number. That's like the last resort. You're better off contacting the main corporate office. If you're going to dollar for dollar, contact the main corporate office and ask to speak to one of those department names. Special assets, secondary marketing, chief credit risk officer, that kind of stuff, okay? I'm looking for my own portfolio. This is a number one thing to say. I'm buying for my own portfolio. I'm not wholesaling. I'm a broker. Don't say that. They don't need brokers, okay? Like I would never call and say, hey, I'm a real estate broker. I want to help you move your notes. Worst thing you can do. I'm buying for my own portfolio. Now, if you're only looking to wholesale, you still say, I'm looking for my own portfolio. Don't tell them you're trying to wholesale the damn thing. Okay. Tell them, hey, we're trying to work it out with the homeowners. Okay. We're looking for something with some hair on it. What's that mean? Well, if you're bald, that doesn't mean you're getting a toupee. It means it's been on their books. Maybe it's nasty, starting to grow some legs, grow some hair that they want to get it off their books. Okay. We're looking to work it out with the homeowners, modify it, reinstate some sort of workout plan if possible. And we're looking for, like I said, first liens in these markets or states. I don't really narrow it down. I say I'm looking for first liens in most of the major markets, excluding New York, New Jersey. We don't like to buy there, but we'll buy just about every other major market across the country. The whole idea, ladies and gentlemen, is to make it easy for that asset manager just to hit the download button on their portfolio and send you a spreadsheet. Download to Excel, send you an Excel spreadsheet so you can start taking a look at it. Now, they're probably going to make you sign a non-disclosure agreement. Okay, and send it. Now, here's the thing. If you start marketing and you start getting people that say, hey, I've got notes available for sale, and they come to you, say, hey, I need you to sign an NDA, that's normal. Non-disclosure agreement's normal. But they want you to sign an LOI, a letter of intent. You don't even know what the hell they have. Or if they want you to provide a proof of funds, you haven't even looked at what they have. When you hear that, it screams to me Joker broker. Okay. Also, if they send you a spreadsheet and it's sanitized, and what sanitized means is they've removed the borrower's names or the addresses. They just give you city states. They don't give you actual street address. That's a waste of time. I can't deal with sanitized lists. Just doesn't make sense. Okay. You can't bid off a zip code. Okay. So don't waste your time. When they send you a sanitized, like, listen, I can't bid off of this. I'm not gonna waste my time on this. Send me the actual list. If you get, and the great thing when you get an Excel spreadsheet, you can often go into the info or the details of who created that spreadsheet and see if it's a freshly created spreadsheet or who the actual created spreadsheet was. It matches up with who the person is. Okay. These are things you do not want to say. Hey, I have 20 million a month to buy. No, you don't. If you did, you would be on the phone talking. Okay. Don't say that. I'm looking for notes and REOs. Yes, you may be individually looking for both, but do not say this when contacting the banks, because they're going to put you into the REO department, and guess what? That's just a voicemail box. Call the listing agent. Okay? That's what it comes down to. Just call the listing agent. No, I'm looking for notes for my own portfolio. Okay? Now, here's the thing. You don't have to say, if they ask you how much you're looking to buy, you say, I got $1 million. Got about $1 million in private capital. That's very true. Everybody can raise $1 million in 90 days. If you follow what we teach, you can definitely do it. We have people who raise 3, 4, 5 million in the first 6 months. They got plenty of money to go buy deals for. Okay. But you're looking for notes. Okay. Just that's all you say. Do not say I'm looking for notes and REOs. Okay. I'm looking to broker or wholesale. That will get you hung up on and they won't deal with you. I represent a buyer. I'm a buyer's rep. No, don't say that's so cheesy. Somebody taught that a few years back, and I literally wanted to tell him, you are stupid. When I get somebody calls me, I'm like, you don't have anything. Okay. I'm looking for anything. Nope, you're not. You're being specific. I buy everything. No, you don't. If you buy everything, it means you're a broker. First lien, non-performing, first liens that are either non-performing or reperforming, $500,000 or less. Now, in the higher valued markets, I'll go a little bit higher, obviously, but that first time home buyer market is really going to have the biggest bang for the buck. And small balance commercial, $5 million or less, we'll take a look at that. Anything over $5 million, for the most part, is getting gobbled up by Wall Street in a lot of cases. Okay. Or will be. And then last, I'm looking for anything in this one zip code or the city. Oh, I'm just buying in Austin. Don't do this. Go do something else. Okay. It's different if you're like, oh, I just want Miami. Well, that's, here's the thing. Say, I'm buying in most of the major markets. Get the spreadsheet to you. If all you're going to buy is in Austin, then look at the spreadsheet then. But don't shoot yourself in the foot. At least get the list sent to you, and that at least gives you an opportunity to maybe wholesale, or heck, give me a phone call, and let's look at the list together. Maybe I'll buy some. Maybe I'll know somebody that'll buy that we can help you make some money brokering that deal. No, you're not telling the bank you're brokering, but we can help you out in that. Okay. All right. The best times, there's 2 ways you're contacting these estimators. LinkedIn, you can do it anytime. Okay. LinkedIn, if you're working another 9 to 5, another job, when I got started, I would basically contact bank asset managers via LinkedIn. I would do it, do it while I'm sitting on the couch watching football. Heck, you'd be doing it while you're doing it now. Okay. If you're going to email asset managers or bankers, there's specific times you want to send an email to, and other times you don't want to send an email to. Okay. Best times to email, and this is actually across the board if you're a marketer, is Tuesday, Wednesday, Thursday. Okay. Don't send an email on Monday. It's going to get buried because they're so busy. Sure as hell don't send an email on Friday. Okay. It's going to get married and they're not going to really look at it until probably Monday afternoon or Tuesday. It'll be way buried down. So don't do that. Okay. I'll rarely send an email out on Friday afternoon. I'll do it to my warm market, like my investors database and all that stuff, but I got to get it out before 3:00. Okay. You want your email to go out preferably between 10 and 3 their time. Okay. Wednesdays at Wednesdays at 1:00 seem to be the best time if you're sending email out. The reason I like to send Tuesday is I'll follow up with a email on Thursday. Okay. And I'll talk about that in just a second. When you send your first email blast to asset managers, you'll see a 10 to 20% open rate the first time. This is talk about like if you download the list from the Texas Mortgage Bank or the Lane Guide, you're going to see about a 10 to 20% open rate the first time. When you send a second email, it's about a 5 to 8% open rate. And the third time you send the email, you get about an additional 1 to 4%. Now, do I send the same email? Yes. But here's what I do. Let's say I have 5,000 names, 5,000 asset managers. I send it to them on Tuesday at 10 a.m. 2 days go by. Thursday, I log in my email. Who opened the email? Great. They get classified into a hot list. Those that didn't open the email. So if I got 20% open rate, that means I had 1,000 open. It means I have 4,000 people that didn't open. They get sent the same email Thursday afternoon. So I get about, say, a 5% open rate on the 4,000. That's an additional 200 people that opened the same, that opened the second email, they didn't open the first one. They're tagged in my hot list. Okay. That leaves me with 3,800 that I send a third email to Tuesday afternoon. And I might get 38, might get 50, I might get a 1 to 4% open rate somewhere around that on that third email blast. But guess what? Between those, what do I have? I have about a 30% open rate, 25 to 30% of my list that I can target who have opened my emails. That's a good starting point. The rest, everybody basically goes back in to my email. Hey, what do you have this month that you're looking to get rid of? Okay. But the ones that open, I'll follow up with a separate email. Hey, saw that you opened my email. Just wanted to touch base with you. Have anything that can we, kind of jump on a call with you? See what you might have. Are you the right person? If you're not the right person, who do I need to talk to? That's the aspect of it. So it's, somebody doesn't open any of my emails, they're still going to get my emails. I've got people that I've emailed for, 15 years now, every month. And what happens is you'll get out of office emails too, where they're out of the office, and they'll all say, hey, if you need to reach somebody, contact this person, this person. That's one of the most valuable things that you can look at your out of office thing, because they'll often tell you somebody to reach out to and add that person or pick up the phone and call that person in. Also, bounced emails, emails that don't go through. Excuse me. They bounce because they've left the company, but they'll often say, hey, here's somebody new. But that's when you would pick up the phone and call the special assets department and say, hey, I used to deal with Forrest. I got an email saying Forrest is no longer there. Who took Forrest's place? I'd love to talk with him or her. Okay. There's a little bit of marketing to this. Great thing is, sorry, everybody, is that you can set up your email blast to go out at these times while at night. If you're you can write them at night, so pre-schedule will go out if you're using like MailChimp or Keep or something like that. Okay. This is one of those valuable things that you can do as a real estate investor is email your database, whether it's asset managers or your warm market list. I don't even want to ask the question, was the last time you sent an email blast out to your database, but I will. When was the last time? How many of you on here email monthly at least or weekly? Weekly is the best thing, not daily. Daily is too much. But once a week to your warm market is what you all should be doing. Okay. Something valuable. Hey, here's a deal that I'm working on. Or, hey, here's a article I thought you might find interesting. You got to share stuff with your audience. Otherwise, they're going to be getting their information from somebody else. Okay. Once a week. Okay. Once a week. And I'll talk about that a little bit later on when we get into the raising capital side, why it's important once a week. Same thing. Asset managers, you don't need to do weekly, but it would be good every 2 weeks. As we get into the summer, people start taking a little bit of vacations. That's okay once a month. But with the market heating up and more defaults, I would start bumping it up to once every 2 weeks. Same thing. The ones that have opened your email, that's your hot list. Maybe those go to once a month. Hey, just wanted to see what you have. But those are also the ones that have opened your email. Those are the ones that you want to best reach out to and start contacting them directly and individually. Okay. Now, if you can't make phone calls to asset managers, I get you. Then what I would do is I would go over to LinkedIn and start finding these people on LinkedIn and message them directly. Okay. If you can, pick up the phone and call a few. Tuesday, Wednesday, Thursday, same time, between 10 and noon their time and 2 and 5 their time. A little bit later in the day, because they're often be working on stuff. I don't usually call them on Friday. I will call them on Thursday evening sometimes if I get a call block, because they're off in the office at the end of the quarter trying to put their reports together. Don't call them on Monday. Okay. End of the month, end of the quarter, they're often working. You can often get some good folks to respond back to that they've got stuff available. Okay. And expect to leave a lot of messages. If you call and get a voice message, don't hang up, leave a message. Your message can be very similar. Speak very clearly, slowly, and repeat your phone number twice. Hi, my name is Scott Carson. Hey, Forrest, I believe you're the asset manager at ABC Bank in charge of your note sales. I would love to talk with you. I've been a note buyer for over 20 years, buying for my own investment portfolio. Just wanted to see what you have in your books. I know that you've got some default stuff based on what you filed, what your company filed with the FDIC. I'd love to see if there's a way that I could take a look at that list and then maybe make some offers. I can be reached back directly at 512-585-3810. Once again, 512-585-3810. And my email is scott@weclosenotes.com. All right. Now, if you're going to leave an email address, make sure it's easy to heck to understand. Okay. Don't say, oh, my email is TigerLily05 or big car or whatever. You know what I mean? Don't make it appropriate. Make it simple. Don't make it a long, drawn out thing where people can make errors. WeCloseNotes.com. Pretty easy to understand. Okay. ForrestHyde.com, one Scott Carson at gmail.com. That's still somewhat appropriate. A Gmail, if it's your personalized, people can understand that. It's, that is sick, but don't leave it where it's all these numbers and stuff like that. Make it simple, make it easy for people to respond to you. Yeah, no TigerLily05 at gmail.com or Forrest Hyde XXX at hotmail.com. Be professional. You'd be surprised how many people don't even have a professional email. You're dealing with bankers. This doesn't mean you need to show up in a suit, which I used to do from time to time back in the day. But they will want to probably talk to you. Okay. And they're going to, what they're going to do? They're going to go to your LinkedIn profile and check you out. So you make sure that your LinkedIn profile is professional. Make sure you got a good photo, a professional photo, smiling, and you say something in your profile about real estate. No, you don't need to create a separate profile for note investing or real estate investing. I'll give you an example. Like Forrest here, he's a realtor. Okay. What I would do though is make sure, and I haven't looked, so as I say, make sure I'm a investor / realtor. Say something in your profile that you've been an active real estate investor for 5-10 years, focused on notes and distressed real estate. Something, might even put that in your title. And the fact that you're buying for your own portfolio is important. Okay. That's the important thing is you can actually go and see who's checking out your profile on LinkedIn. It's great. And that's how I know this stuff works, because when we send messages and when we send emails, I see a big increase in my LinkedIn profile. The only social media that I will usually put in my email and ask managers is a let's connect on LinkedIn. Boom, right there. Or let's schedule a call, 15-minute phone call to jump on and talk. Something simple to make it happen, okay? And smile while you dial. If you're having a bad day, don't do this. Don't mumble. I had one guy that would do it. He'd mumble like he had a mouthful of a mouth of rocks. Blah, blah, blah. Sometimes these asset managers are having great days. Sometimes they're a little stressed right now, okay? So the more pleasant you can be, the better off it's going to be for you to get that. And leave messages, just as a habit of what you get in the habit of, okay? Expect if you make 50 phone calls, and yes, you can make 50 phone calls in a day, you're going to probably get a hold of about 14 people. Out of 14 people, 4 or 5 of them will have a list, and you'll probably sign an NDA and get a list out of those 4. But that one list might be And that one person on your list might be something that you get every month, every week. Okay. When I first started off years ago, I was hoping I'd get 100 connections in a year. Well, I quickly changed that number to 1,000 because it was that's the aspect that you never know who's had this stuff. And when I drop an email, the emails the second month, especially when they're hot, was, hey, just just touching base with you, see what you have on your books. Maybe you've got anything you're looking to get rid of, any one-off assets, or hey, if you've even got stuff like there was one month I did one. I'm looking for stuff in Ohio and Michigan. We've got stuff there, or hey, we've got a new investor with about $1 million in private capital behind us now. If you got anything we're looking to buy, just that steady drip marketing campaign, it will build long term. This is not a get rich quick. It is a build wealth aspect, and this is a way to build a true business as a note buyer. The biggest fallacy and the biggest mistake that most note investors make is they don't market. Like there was just an event that took place in Nashville last weekend. Maybe 150, 200 people at it. I guarantee nobody talked about marketing there. Or they talked about maybe Instagram or posting LinkedIn. The basics of marketing is still sending an email blast out. You still have a 4,400% return on investment in reaching out to asset managers via email. You got to do that. This is what separates us from everybody else, is that we never have a deal flow problem because we don't rely on one or two sources. And that's what a lot of folks do, is they get to one spot, like they used to rely on, what was it called? Granite Loan Solutions used to have put out a list every month. That was great. Well, they went out of business. Or people are looking at stuff on PaperStack. Well, PaperStack has maybe 135 notes, maybe. Crap a lot of times. So that's been sitting on there for a while. Not a direct source. You got to go out and market to find deals. It just is what it is. If you embrace the marketing, you'll be happier. You'll raise more capital, get more deals, and ultimately, guess what? You'll make more money. Okay. And like I said, expect to follow up. We keep, when we make phone calls, we keep a track of who we made phone calls to, so we can follow up with them later. Send an email, make a phone call, connect on LinkedIn. Those are 3 basic things that you can do on a regular basis, and rinse and repeat. Okay. 80% of sales are made after the 5th contact. That's what you have to realize. Only roughly about 48% of people follow up it more than once. That's why we've done so well, is that we understand and embrace that 5th contact. Okay. There's a time when I was contacting banks. Okay, when I first started off, my first batch of making phone calls, I made 50 phone calls on a Thursday afternoon. Okay. Well, it was actually a Thursday. The mortgage business was slow. I started picking up phone calls. On the last call, before I wrapped up for the day, I get a hold of a lady named Kim, who was with Aegis Mortgage out of Houston, Texas. Aegis Mortgage had closed. She was the last employee besides the president of the company, and she had a portfolio of loans that she needed to sell off. Now, I almost left before making a phone call, but I picked up the phone and called. I got her on the phone. She's not having a good day. Kim Kroc was her name, if I remember correctly, was her last name. And she's like, what? Yeah, hello. I'm like, is this Aegis? Yes, it's what's left of it. I was like, hi, my name's Scott Carson. Sorry to bother you. I hope you got big plans for this Friday or this weekend. She goes, well, I'm about to lose my job. I'm like, oh, I'm so sorry to hear that. She goes, yeah, as soon as I sell this portfolio of loans, I'm retired. I'm gone. I'm like, well, let me help you get, lose your job. She started laughing. It led to a $5 million portfolio, 5 points we made on the deal because we had a few people. So we made $250,000 on that deal. Every no I got on that phone, every no was worth $1,000. Okay. Yes, 250 split basically 5 ways. Took me 5 people to make it happen, but 50 grand for 50 calls was a pretty good week's worth. Can we agree to that? Hell yeah. Another resource, I knew Capital One had some notes available for sale, or their previous commercial lending, Greenpoint Mortgage. So I started dialing for dollars. I was actually looking at a strip mall here in Austin, Texas, that the note got sold and the listing was canceled. And I was like, okay, so I know they got notes for sale, right? So I started dialing for dollars. It took me, I'm not joking, 3 weeks and 70 phone calls to just, I can tell you how many times I got bounced around, okay, till I find the right department, okay? Finally get this lady, Amy, on the phone. She's like, yep, I'm the right person to talk to. I'm like, awesome. She sent me her list of non-performing small balance commercial, anything under $1 million in the United States. It was 33 pages in 6-point font. Okay, I had stuff in all 50 states. It was very, very small. Some had a lot. That was $1 million relationship. Okay. Made $1 million off that relationship. The first note I bought off that list, I flipped for 35 grand. So every 70 phone calls divided by 35 grand profit, every hang up was worth $500 to me. That's how I gamify it. Now, that's relationship. Every no I got was worth a whole lot more because we ended up buying a 12-unit apartment complex note deal, bought a 20, flipped a 20, looked at a 70-unit in Miami that we ended up flipping for a wholesale fee, made 100 grand on a wholesale fee on a 16-unit apartment complex in LA, Los Angeles, and some other stuff. Okay. This is what I'm trying to get at, ladies and gentlemen. This is how to build a sea of referrals for you. Because a lot of these asset managers, they don't have a list. Okay. You got to follow up with them for them to send you a list. Some do, and they just send it to you on a regular basis. Hey, I've got this list, or they're on your buyer's list. I mean, I've been getting stuff from Quicken Loans for years that I can take a look at their residential stuff. And sometimes it doesn't make sense. Some of the pricing they don't want makes sense. Sometimes it does. It just varies. The whole idea is that if you've heard of, residual income, residual deal flow, it makes it so much easier. That's why I can work from home or work wherever the hell I'm at, Orlando, middle of the freaking Mediterranean. Okay. I can set up my email blast to go out. I get lists in. I can work on those lists. And that's the beautiful thing. I don't have to leave home unless I want to. Okay. And then those that you talk to, make a separate hot list that I talk to them once a month, or I send them an individual email, not through my CRM. Hey, just touching base this month. Keep track of it because it goes a long way in helping you systemize your marketing. And follow-up is so key in this business, okay? There's a 4-hour video of me calling asset managers you can take a look at by going to bit.ly calling asset managers. You can see me making these conversations, hear the wording. It is not as intense as you would think it to be, okay? They're just normal people. Most of them are really nice people. Ladies, if you're on this, you actually have an easier time with this than guys do. Okay, because contacting banks, if you're a lady, and again, most of these guys or most of these asset managers are men. And who do guys call back first? They call back the ladies. Okay, not being sexist. It is what it is. All right. I always found that the women that were in our system or in our classes that called asset managers, they always got a lot more. Stephanie's like one of the best ones in it. Okay. Now it helps if you don't have a voice that sounds like you smoked like 4 packs of Marlboro a day. But if you've got a thick accent, hire a VA to do it. There's English speaking VAs that can do that. Reach out for if you want to. But that's still follow up. Okay. One of the things that are the next step people often will take after going through this 1-day class is our Note Buying for Dummies class. Like I said, our next one is January 21st to the 23rd. We spent a full day on Friday just showing you how to find. Once we go through in-depth scripts, we give you more scripts. We show you exactly the video that we use. We show you what we say on LinkedIn to automate it. There's a great tool or two that you can use to automate the connections. Saturday is all about the funding of deals, raising capital from IRA investors, figuring out how to structure those deals, how to find them, what to market to them, what to say, what not to say. And Sunday is all about the flip, the exit strategies. There's 10 different ways to make money in notes. Go through that, we show you structures, and we even start breaking down full tapes for you to take a look at, make offers on. So if you go to notebuyingfordummies.com, just HTTP, semicolon, you don't have to put an S in there. Actually goes faster if it's just notebuyingfordummies.com without the S. And then use the code weekend. It'll when it signs up, it's usually $9.97. If you use the code weekend, it'll cut that price in half for you. If you're a little bit more crunched and don't want to spend $500 in a class, you can sign up for a monthly membership. That's just $97 a month. That gives you access to the replays of our workshops, replays of our classes. We upload lists. We do weekly coaching calls. It's really a great bang for the buck. If you go to noteumbrella.com, you can get signed up for a monthly membership at $97 a month. All that we ask is we do a lot of stuff with our membership. There's a lot of great benefits, classes, stuff like that, is that you hang around for 6 months. If you're just going to sign up for $97 and cancel after a month, we're going to charge you the other $400 of what you take to take the class. Just is what it is. Okay. If you're around for 6 months, $97 a month. You're like, after 6 months, cancel anytime. Okay. That's noteumbrella.com to get signed up for our monthly membership. All right. Let's do this, ladies and gentlemen. Actually, we're going to go through this next session, and then we're going to take a quick 15-minute break for you for your midday break for you. All right. Any questions before we dive into the markets and pricing of notes? Moving on. All right, everybody. So as we dive into the different markets and stuff like that, there's got a question here. Parnell, he asked me, would you please post the links to the videos mentioned? You should have gotten an email with a link with a manual, and those links are in that manual that you should have received. Okay. If not, I'll re-email them out with the replays, but those are where they're at. They should have gotten there for you to actually be able to use. Okay. All right. Moving on. Let's go in here. Session 5, markets and pricing. Market expectations. Look, we've talked a little bit earlier about how markets can vary based on foreclosure timeframes and stuff like that. You know, it'll vary on the popularity of a market. Like Austin is much more popular. Austin, Texas versus Austin, Minnesota. Miami, Florida is much more popular than Miami, Ohio. Okay. Market values will change, you know, same thing. Paris, Texas is not going to be much as well. You're not going to buy notes of Paris, France. But what I'm getting at is that market values, the higher market value is, more popular is, you're going to pay a little bit more for it. Okay. Foreclosure timeframes obviously have a bigger impact. This is why when I do buy a note that's in a longer foreclosure state, I want to know where they're at in the process. Like I give you an example. Some of these notes that we're looking at Florida, I asked, they say on the spreadsheet, oh, it's in the foreclosure process. Well, when the bank sends me the list of the due diligence, they say they just started the first legal. That changes the price point on these tremendously, because I'm not going to pay 80 cents on the dollar and have to hold it for a year. I want something that's a little bit closer. I'm going to pay 80 cents. I want it to be a relatively foreclosure. It's almost wrapped up, right? Population. When you're starting off, you probably want to stay in higher cities. You know, populations of 50K or more for the most part. Why? So that there's plenty of buyers, plenty of rehabbers, plenty of vendors, realtors, people that are looking to buy in that area. I wouldn't necessarily go buy in a small market. Now, like I'll give you an example. I grew up down in South Texas. Okay, Corpus Christi. There's about 300,000 people at. Across the bay from Corpus is a place called Ingleside with 10,000 people. I would buy in Ingleside because I know that area. Aransas Pass is about 5,000 people. I would buy in that area because I know that area. Okay. I wouldn't necessarily buy in that area if you're brand new and you live across from Florida. Okay. Especially if it's something that you're going to end up foreclosing and probably have to rehab. Definitely want to be doing rehabs across the country as your first deals. I'm doing some rehabs in other parts of the country because I've got teams and people I like and trust, and we've done enough of that neck of the woods. Okay. Avoid rural assets unless it's something like, I'll give you an example, like if you're looking to buy, like we were looking at this 5 acres outside of Anderson. It's a rural area, but I would be comfortable with that. You know, we were looking at another note that was in like rural Florida, 30 acres attached to it. Okay. I was interested in that. Had a house, single family home. I was like, oh, we could buy that, rehab it up. And we like Florida. Okay. Take a little while to foreclose, but it'd still be something popular. Okay. You have carnal knowledge of areas, stick with that carnal knowledge. If you don't have carnal knowledge in the area, guess what? Jump on a Southwest Airlines flight and go out and find out if you want to. But stick to the major markets. You're going to be happier to begin with. It'll be easier for you. The biggest mistake I've seen new note investors make is they buy a deal because it's a deal. They think it's a deal, and it's out in the podunk and they can't get it foreclosed. They can't get the seller served. Nobody wants to buy it. They end up losing money. Don't do a deal to just do a deal. Do a deal to make money. There's plenty of deals out there, and true deals, not duds. Okay. And the inventory. Like I said, I don't just focus on Austin, Texas, because the amount of distressed notes here is smaller compared to a lot of other places out there. Now, what's hot is the most expensive note markets. I talked about California, Arizona, Texas, Nevada, Georgia. Those are the hottest markets. You can even throw in anything on the West Coast for the most part. Is just, and by hot, overpriced. Okay. Way overpriced in those neck of the woods. What's not the least favorite markets, New York, New Jersey, okay, Kentucky, Chicago, or primarily Cook County, Chirac. Assets that have low values under 30,000, not necessarily the greatest things to spend on. or deals that have a ton of equity above the legal balance. And the seller wants you to pay 80, 90 cents. That's not exciting. Okay. Only time that makes sense is if the numbers make sense. Most of the time, somebody wants you to pay 90, 95 cents a dollar. Just doesn't make any sense, even if there is equity. You're not getting the equity unless you foreclose and it doesn't sell at the auction. You can't guarantee you that. Okay. Where's the most inventory now? Ohio, Michigan, Indiana, still the same. Those three states often have more than anything else. Illinois, Missouri, Florida, the Carolinas, South and North Carolina's got quite a bit of stuff. Florida's got a bunch of stuff. And then you're seeing small balance stuff. And that's all going to vary by asset class and what's going on with that specific bank in those areas. Let's see, the Carolinas means both South and North Carolina. Okay. I would also throw in, there was another one that I just thought of. Oh, Georgia's starting to see more inventory in Georgia. Okay. The pricing models on that. There's basically a couple ways to price this stuff. Okay. Non-performing notes where there's negative equity. What does that mean? It means there's no equity. It means the borrower owes more than the property is worth. We do something tentatively called the stair step. Now, here's the thing. You're always going to ask the seller when they send you a tape, what's the pricing? What do you want for this stuff? Do you have any price expectations? Do you have any reserve pricing you're looking for? What are you looking for in this stuff? Highest and best. Okay. If it's negative equity, then you're going to do a stair step process. We'll talk about that in the next slide. Okay. If there is equity, non-performing with equity, they're going to want roughly 80 to 95% of the unpaid balance or payoff if their legal balance is way above the UPB and well below what the legal balance is. Okay. So if there's equity, they probably come to around 80 to 95%. You got to look at what that 20% of legal balance, whatever it is, that a profit, is that worth your time to take it down? Now, if I'm paying 80 cents on the dollar for a non-performing note that's vacant, that I'm going to foreclose on, does that make sense? It may not make sense if it's occupied, if they want to restate the loan. It just varies on how you calculate that stuff. Okay. Contract for deeds, if it's non-performing, you're going to pay 30 to 60% of lesser UPB or fair market value. That number is kind of, if it's got equity, they want you to probably start pricing it like a regular note. Junior liens, I just don't even waste my time on, way overpriced. Commercial, that's going to vary by cap rates, asset classes, stuff like that. Here's the thing that's going on with commercial, ladies and gentlemen. With interest rates going up, cash flows being down, most banks are going to sell, borrowers and asking them to bring, 15, 20% cash because the asset value class has dropped. When you got cash flows that go down, the value drops down. Okay. So I've seen commercial notes sell at 10 cents on the dollar now, depending on the asset class. 50 cents on the dollar, 75. It just varies on an asset by asset basis based on cash flow. You're going to submit your bid most of the time as a percentage of UPB or value, whatever that number is, but you're also going to take a look at taxes owed. One of the most important things, whatever your offer is, say my offer is going to be at 100 grand, but there's 6 grand in back taxes, so my offer is really 94. Okay. Now, if there's a ton of equity above it, they may not want you to take the taxes off. You figure you pay that off. It all depends on where it's at. And once we look at more deals specifically, that's going to give you the bigger and best look at it. Now, if there's less than $1,000 owed in back taxes, don't worry about it. Okay. Let me give you an example. Let's say borrow owes 500, house is only worth 400. There's 50 grand in back taxes. Well, if I'm going to pay, if it's 400,000 is basically the true value of the asset, then say 60 cents on the dollar, that would be 240. If there's 50 grand in back taxes, and then I would take the 50 off that, make it 190 would be my offering. Okay. Flip it around. Say it's worth 500, but they only owe 400. Well, 80 cents on the dollar, 400 is 320. Okay. Minus 50 cents would be 270, but they're probably going to want to push back on that taxes owed and want you to come closer to 320. Does it make sense on that? Yeah, maybe it makes sense to sell it at, that I can make 70, 80 grand. If they won't deduct the taxes, though, I'm only making 30 grand for the most part. It just doesn't make any sense. With negative equity, this is the stair step model we talk about. Any assets that are below 30,000, you're going to offer like 25 cents on the dollar. Okay. This is the fair market value here. If it's at 30 to 39, 35% of fair market value. If it's in the 40s, 45% roughly, give or take. If it's 50 to 59, roughly 55%. And if it's 60 K plus, they're going to want you probably come in at 66. Now, this is if you're cherry picking the best asset, or they're only doing like a one-off. Okay. You would take this, whatever, 65% fair market value minus taxes. Remember, this is negative equity. They owe more than the property is worth. So as investors, you can only look at the value of the property at that point. Remember, they owe more. So if you do foreclose, the borrower is not going to get anything. Okay. You would deduct this down, you may make it from 65 to 60 if it's a longer foreclosure market, and they're only beginning. All right. Now, if they're in a short foreclosure, or foreclosure is due in like 60 days or less, you might have to go to 70. So it's just the guide. It's not a rule. Some people get all bent out of shape. Stair-step pricing is the wrong way to do it. If seller tells you, you got to protect your ass, okay? I'm not paying 90 cents on the dollar for a $30,000 asset. Okay, I'm not going to pay 27 for a 30. It leaves me no room to make any money in a foreclosure, or if something goes wrong in the deal. So that's why you protect it. Okay, it's always funny when you get people that have bought maybe a handful of notes that don't do this on a big time basis. If you're buying the cherry of the cherry, yeah, stair step doesn't work because you're buying one off note in the best asset. You have to pay a premium for that. When you buy in bulk, okay, there's a lot of good singles and doubles when it comes to deals. Not trying to hit a home run every time. All right. So that's the negative equity, or as we call that, the stair step price. Okay. Why you want occupied assets? Yes, you actually do want occupied assets if you're in the note business more so, because it gives you more exit strategies and more options. The reason you want occupied assets, they're usually in better shape. It means they're occupied. Somebody's taking care of the property, keeping the power, the gas on, the electric on, the AC is working, the roof is decent. Okay. They're not leaving windows open in the middle of the winter, or the copper's not ripped out of it. They're just usually in better shape. There's more options to make money on these by getting them reinstated or modified versus just a foreclosure deed in lieu process. Like I said, easier to reinstate and modify. It's easier for that deed in lieu, cash for keys, to do a friendly foreclosure. And oftentimes the emotional equity. By emotional equity, if they've got kids, if they've lived in a neighborhood, if you're looking at an online photo that's relatively new and you see flowers or landscaping, somebody wants to stay in that house. So let's work out a way to keep in this house instead of foreclosing. So if you moving out and have to go somewhere else, let's take that $2,000 that you'd spend on that and put it towards your balance. Okay. And most importantly, less capital expenditures. You're not going to be spending a vacant house is going to lose the HVAC most of the time. Or if it's been vacant for a while, the roof may be bad, or it may needs new wiring, or the copper's been ripped out, or the plumbing's not working right. Okay. If it's occupied asset, or if it's got a tenant in place, this works well. You know the condition of the property is probably in better shape. If it's vacant, you definitely want to get into that property. Like I give you an example, these 8 in Florida, they're vacant. They've got an internal BPO from a year ago. I'm like, that's great, but that doesn't help me. I need to get into your access. I need a lockbox to be able to go look at these. If you're not going to let me do, and these are reverse mortgages, borrowers are deceased. Okay. I know HUD's already gone in and put locks on them because I've driven by a couple. Okay. If they're not going to give me the lockbox code, then I'm not going to finish closing on these. I'll be like, no, I need to get into your access. If you're not going to give that to me, never mind. Let's see here. If you go to 100K, and here's the link. Please keep your questions relevant to what we're talking about. There's plenty of breaks to ask other questions there for you. But anyway, thanks for joining from YouTube, Ive. Appreciate it. All right. But anyway, I like occupied assets. If it's vacant assets, been vacant for 4 or 5 years, you're going to have basically a rough deal and have to foreclose and a big heavy rehab. If it's occupied in decent, it's in better shape. Okay. Any questions about that before moving on to different funding options here in a few minutes? Let's move on. So Parnell asked a question, is there any way to get maintenance records during due diligence? Not usually, because here's the thing. Now, like maintenance work, like these reverse mortgages, they've secured the property. There's going to be a sheet oftentimes in the asset that shows when somebody visits the property. You might be able to see some work done. Like I was just looking at one in Minnesota last week where you can see that there was some water damage in 2023 and it was repaired in 2023. There's actually a sheet in there. But Most of the time, not. Most of these properties haven't been maintenance. Okay. Most of them are winterized. Okay. If it's occupied assets, you have no clue. You're not going to be able to get into if it's occupied. You have to understand that. Okay. And that's the fact that you're buying at a bigger discount. That gives you the flexibility to have to rehab. You can't go after repair value. ARV does not exist in the note business because we don't own the asset. Now, is it nice knowing that you're buying in an appreciating market? And if you do foreclose and take it back, that you have that extra appreciation? Yeah, it's great. But you can't count on that. That's just the cherry on the top. Okay. Part of the reason why we buy occupied assets is the fact that we don't want to rehab. We want that borrower. We want to rehab the borrower. That means not send them to Betty Ford clinic, but get them back on track. Okay. When you're starting on the note business, that's the best way to go. Occupied assets that have been non-performing, really then no later than COVID. It's been 4 years since COVID. If somebody was non-performing prior to COVID, they haven't been performing, that's a foreclosure all day. If they were performing prior to COVID and it was a COVID default and they've been hit and miss, that could be a modification reinstatement is the way I look at it, the way I evaluate the markets. Okay. But if it's vacant, you really need to put eyes on it. You may not be able to get into it, but send somebody out, peek in the windows and go from there. Maybe you need somebody out with a boot hammer. We're rehabbing the borrower, not the property. Now, like I'll give you an example. I got this. I mean, if you get a list of them and they're vacant and there's a lockbox, I will ask, can I get into it? Now, here's another thing that's nice. If a seller's tried to sell the property before in the last 6 months or a year, you may be able to see interior photos if they were trying to sell the property. Okay. Or they were trying to rent it. We've got interior photos that way before from the seller who was trying to move the asset or rent the asset. That showed what kind of condition it was. That helped us. Don't count on that. Okay. But this is why we buy at bigger discounts, because if we do it to foreclose, we may not have to rehab. If we can price it at 85, 90 cents on the dollar at auction, great. Let's sell it that way, make my money and move on. If it's a negative, so if we're buying it at 60, I'm finished the foreclosure. If I can price it 85, 90 at the auction and make my 25, 35%, that's a good deal for me, then let's do it. Sell it at the auction, get your money in and move on versus having to take it back, fix it up, pay commissions. You're probably going to end up netting about the same anyway. All right. So let's talk about funding options as we move on. Any other question? Good question, though, Parnell. Thank you for asking that. And if you're watching the replay, ladies and gentlemen, if you have questions, and I'm not answering them as we go, most of the stuff builds on. I think you understand that. Always email me, talk@scott@weclosenotes.com, or book a call with me, talkwithscottcarson.com, and I'll book a call on my schedule, and you pick away questions, and it'll take you directly. And yes, I answer my email. Yes, I answer my Calendly, and you book your call with me, not somebody else. Okay. So let's get into funding options now. So how are you going to fund these deals? You're going to need some cash or other people's money. You're not going to go get a note from a bank to buy a note. Okay. You'll be wiring money into the bank, wiring money into the seller. You're not going to close at a traditional title company. Now, this is buying institutional debt. Okay. There's no title being sold. The title's still in place because you're buying the note, not the property, right? So there's no title insurance being created. So a title company doesn't want to close these because they can't make any title money on it. So you're just going to close either through an attorney's office where your money is wired in. They provide a copy of the collateral, copy of the deed, and then once that's done, then the attorney wires the money to the bank. Most of the time, when you're dealing directly with banks, you're just going to wire directly to the bank, and then they're going to send you the assignment of mortgage, which is what transfers ownership, a copy of it that day with a bill of sale, and then the stuff's going to show up in a week or two. You can use business lines of credit if you want to use that. Some people want to use their home equity line of credit. You got to be very careful about that. Don't cash out your cash advances on your credit card. Somebody did that. They pulled 70 grand off their credit card. I'm like, and then they sent that money to me to fund a deal. 6 months later, they're all panicked because there's 0% interest gone. I'm like, listen, Nick, this is a 24-month deal. How the hell did you expect it? Oh, I don't know. I thought you'd be done with it. I'm like, I told you it wouldn't be done in 6 months. So why are you doing that? So I had to not refund their money, but cash them out and move on to somebody else because they were just stupid. IRAs. This is one of the great sources. Okay. Now, if you're looking to build business lines of credit, get with Merrill Chandler at getfundable.com. He's one of our best guys to go do that. That's what he's an expert in. Okay. Helps him get lines of credit, personal business, stuff like that. He also did a boot camp. He's changed this up a little bit. He's got a new boot camp coming up in August, I believe. Check out getfundablepbootcamp.com. I really believe it's a required 2-day course. You'll learn more on that about credit and your personal credit report and using credit and stuff like that more than anything else out there. But we use 90% of the time OPM, other people's money. Yes, we use our money sometimes, but we use primarily OPM. And that can be a lot of self-directed IRA funds. People that have a traditional or a Roth, or they've got a 401k that they've rolled over into traditional, or maybe they're self-employed or business owner, they have a solo 401k. Maybe they're using a SEP IRA like I have. You can also use a self-directed HSA to buy notes. If you've got a high deductible insurance, health insurance plan, you can have an HSA. Some people use an educational IRA, like a Coverdale. We've got some folks that are taking their family members and putting $2,000 a year into it for their kids, and they're combining that together, not pool their money, partnering on the IRAs to buy one note, and then whatever percentage of what they funded, the percentage that goes back. Okay. There's a whole variety of different IRA accounts. You can go through this video and watch that video whenever you want. Just talks about the different. If you don't have a self-directed IRA, go get you one. It's one of the most valuable things you can do. If you go to rocketdollar.com, they usually give us a discount of $50 off if you go use the code NOTECAMP to set up an IRA with them. To give you a bit of an idea on what you can contribute to an IRA, the numbers for what you can contribute to in 2024 have gone up just about across the board. Yeah, everywhere across the board. In 2023, it was $6,500. You can now contribute $700 or $7,000 to a traditional. Same thing on a Roth. An HSA, you can now contribute up to $4,150 individually or $8,300 as a family. You can put away up to $23,000 into employee 401k contributions. SEP IRA, you can put up to $69,000 away. That's great. And the solo 401k, same thing, up to $69,000 away. So there you put a lot of money. If you're making a lot of money, put away in there self-directed. And yes, you can use your own IRA to buy a note. The thing is, you can't do any of the maintenance. You'd still need to hire a third-party servicing company to do that. And that's okay. That's what's great about IRAs and notes, is that you have that third-party servicing company to do it. Now, if you end up foreclosing, taking the property back, you're going to have to hire property management and that kind of stuff to do that. So if you use other people's money and pay them a flat 8% or 7% or 10% return to them to borrow their money, guess what? You can go out and do whatever you want with that note. Okay. You're just paying your investors back their money at 10% and either paying them back when you sell the note or when you foreclose and sell the asset. Okay. Other ways to fund or even collateralize. Here's the thing. When you're borrowing money from another investor, there's a lien on it already. You can't go put another lien on a property you don't own. Okay. You're the bank. So what can happen is if somebody's going to give us money, we'll collateralize to a collateral assignment, where basically we'll sign the collateral to them to hold from other notes we own or the existing note. They can hold on to that collateral from the note that they're funding and hold that as that's their security bond. Can't foreclose with the collateral. Okay. A UCC1 is usually filed at the county against that LLC. So just in case they sell something or they sell the asset off, boom, the money goes back to them. One of the most popular ways is to do co-assignment of interest. Now, what happens when his note is sold, it's not a deed that's filed. The deed's still the same. Remember, same borrower. So when a mortgage is sold from one bank to another bank, what's created is an assignment of mortgage, an AOM, as we call it. And that says ABC Bank assigns its interest or whatever to Scott Carson, LLC for such and such notes recorded on such and such date, right? So if I'm borrowing, say Forrest wants to give me $50,000 to fund a note purchase, what we could do is on the assignment, it says ABC Bank assigns 50% interest to Scott Carson LLC and 50% interest to Forrest Hyde LLC or IRA for Forrest Hyde. Now he doesn't get 50% of the profits. There would be an operating and funding agreement that outlines that, hey, you're getting 10%, but you have an interest in that note. Okay. Some people like that. Other people don't like having their IRA name out in public, and that's totally fine. Whether way you want to go, you can. If I got a property with a ton of equity, I can put a second lien on that property for the amount that I'm borrowing to buy the note. People sell partials to finance the purchase of new notes. Okay. Or if somebody's going to bring a sizable chunk to the table, you start a new LLC with the investor. Okay. Yeah, if somebody's bringing 250,000 or more to the table, we'll go create a separate LLC just for that investor, where I own 51% of the LLC, they own 49%, and then that LLC is buying us. Then we can legally like split that better than a flat return. Okay, just depends. Talk with your investors what they want. Some are more comfortable with different ways. It's a conversation, but don't let this stop you. Don't go out and say, "Hey, I'm not going to buy a note, so I'll go raise capital," because investors want to see something tangible. We raise capital at the same time that we're going through the deal process. Yes, we've done it longer, so we have a lot of people sitting on the sidelines, but you can raise capital at the same time that you're raising, but you got to start that marketing process on the front end, not the back end. Okay. Yeah, investor funds the LLC basically is another way. But buying shares, you can structure that as a, whenever you use a self-directed IRA, it's going to be a direction of investment funding form that you're going to fill out. Usually need a lending agreement, copy of the note, stuff like that. A couple different ways to set it up, but we'll talk when you get into that. We can help walk you through that to know what's going on. Will a bank give me a note loan? No, not usually. Banks will not lend on notes. Some hard money lenders or some smaller banks will. If like I'll give you an example, Eddie Gant with the Jet Funding in Houston, he creates notes because he's a hard money lender, right? So when he makes a loan, he will then give that collateral. The bank will give him a collateral assignment. Will give him 50% of the loan. So if he made a loan for 150 grand, they'll give him 75 grand and most immediately by doing collateral assignment. So now he's replenishing his hard money loan, so he can make more loans. Some will do it, it's pretty easy to do in that case on too hard. Some banks will also joint venture on commercial notes. We've had this happen in the past where we're buying a note from a bank, and the bank was, well, if you'd like to looking for a joint venture partner, tell us what you want to do. Because sometimes banks don't want to, just because they've had that relationship, they don't necessarily want to lose that note, even though it's due. They may be willing to finance your purchase of that note if it's usually $1 million or greater. Okay. And then it's one way for them to move that note from the non-performing side of the bank to the performing side of the bank. So we've had that happen before. And like I said, you're not usually going to get a collateral assignment until it's $1 million or greater. We've had some suits that's smaller on some commercial assets that the banks didn't want to take back, and the owner was walked away, so it's helped them out that way. Okay, but you usually got to have a team, especially on the commercial side, that's experienced in that asset class and operations. Okay, and they may still require you to bring 15 to 20% down of whatever that purchase of that note is. That's better than have to fund the whole 100%. You know what I mean? Okay. Questions? You won't buy a note from a hard money lender. I mean, you can, but they usually don't want par. Most hard money lenders won't lend on notes. They don't want to lend on it. They're in the creation process. I don't get it, but they like short-term deals, 6 to 12 months. They like control of the asset. They want to be in the first lien deed. They make their money on the points and the spread. And they might have notes for sale that you can buy, but they usually don't want them at par because they're already written at 65, 70% of value. Okay. But they can have a higher interest rate, usually at 12% or greater. If you've got some cheap funds that you want to put to work, great. You might even buy some non-performing. We bought hard money loans from hard money lenders are going out of business in longer foreclosure states. Okay. What else do I add to the funding? When you're funding a note, it's not just the purchase of the note. You may want to also add the taxes and determine if you're going to have to pay the taxes before you foreclose. If there's a pending tax sale coming up, you may want to go ahead and add in the taxes that get funded, so your investor funds that as well. You may want to review values from BPO or qualified realtor CMA. Add some your due diligence costs, the title, cost for title, update, BPO. So basically maybe another $1,000 for due diligence costs. Always, 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 always put eyes in an asset before closing. Make sure it's still there. Make sure the online photos matches with what you see. If they send you an old BPO, make sure it's not missing a roof or anything like that. You're going to want to budget in your foreclosures, taxes, workout, servicing costs. What I always like to say is that if you're figuring foreclosure, we figure $3,500 to $5,000 for foreclosure costs. Taxes are pretty relevant, figuring out if you can either delay or you got to pay the taxes a minute. Workout servicing costs about $1,500. So at least $5,000 to $6,000 on the foreclosure, servicing, workout costs. And then if you need to, if you're buying it cheap enough and you know you're going to have to rehab it, then you want to figure in some repair costs, 15, 20 grand, depending on where it's at. I had budgets be 50 grand before. I've had budgets be 1,500. Depends on the asset. Okay. But you don't have to figure this on the front end, because if you think you're going to sell at the auction, great, don't add that. But it may be something you want to prepare your investor for. Okay, if we don't sell that auction, I may need to come back to you and get the repair costs along the way. Okay. Insurance is a very big thing, forced place insurance, especially in Florida. Houston, here in Texas, got more expensive. So make sure to check out your forced place insurance costs. That can get kind of pricey. There may be some HOA fees that need to be paid. And sometimes they get wiped out. Sometimes you only got to pay a percentage. Water bills usually got paid. Code enforcement liens that won't go away. Look at what those are. That's why you pull title to see what's outstanding on title. And like I will usually add $500 to $1,000 additional on top of these stuff for marketing costs, due diligence, obviously, or asset management fees, depending on what's going on. Okay. When you add these up, you want to stay below 65% of the as-is value when funding, making sure that's if they owe more. So if it's worth 100, make sure that all this stuff added up isn't more than 65%. Okay. Otherwise, it's too skinny a deal. There are 5 things that protect your investors, and this is something to keep in mind. A, we're only buying first liens. That's very important. I don't buy second, so I'm not going to put your money in a second position unless I own the first 2. Okay. Only buying first liens. We're buying at 70% or below of as is value, not ARV. We're buying at a discount. We're using servicing companies and attorneys to foreclose and collect. We're going to put forced place insurance, property insurance in case of an act of God or angry borrower. And we're always going to check title and the collateral files. We're always going to do due diligence on that to make sure that we have the right, all the paperwork is right so that we have the right to foreclose. And we're going to use professionals. It's not me servicing. It's not me collecting. I'm not going to be flying to the rehab. We're going to use professionals to do that. It's one of the most important things to keep in mind. Okay. Got a question here from Parnell. Let's see what he say. When a homeowner is a borrower who is behind on their mortgage contacts you, is there a way to contact and buy that note from their lender to rehab the borrower? This happened to me recently, but I didn't know how to help them. So no, look here. So it's just, if you have a distressed borrower, like if you send out postcards or foreclosure and somebody reaches out to you, it all depends on the lender. If it's Bank of America, Chase, Citi, Wells Fargo, you're not going to buy from those big 5 or 6. Okay. All depends on the lender. Yes, you can buy that note. If the bank's willing to sell that note and you reach out to buy that note, yeah, you can buy that note. But here's the thing. Depending on what you buy it for, you probably don't want to, if the borrower will work with you, it all depends on what they can pay. I wouldn't buy the note and then modify the loan, make it a whole lot cheaper for them on the front end. No, you're going to make some payments. Okay. Like I don't target distressed borrowers, say, hey, I want to buy your note. No. You don't want to do that. Okay. Now you can't talk to the borrower ahead of time. Same thing if you get a listing from a bank of notes and contact the borrower and say, hey, can you modify? Do you want to stay in your house? That's illegal. You can't do that. Can't contact the borrower because you don't actually own the note to negotiate. That's a big Fair Debt Collection Practice violation. CFPB will fine you $50,000 per case on that. Okay. But it all depends on who the bank is. All right. So like I said, Bank of America, Chase, Citi, Wells Fargo, Nation Star, stuff like that. Those top 5, 10 banks, you're not going to be able to buy a one-off note. Okay. Now, in some cases, like I had somebody reach out to me who wants to buy a note in New York. It goes to foreclosure in 60 days. Might be able to buy that note from that bank. I don't know. It's a smaller bank. I haven't heard of them. We reached out to them yesterday. Left a couple of messages. We're following up on Monday. If the bank is 90% of the way through the foreclosure process, they may just go ahead and say, no, we just want to go and foreclose. It's weird right now. Some would just finish the foreclosure process. Others, like if they could sell the note and they ain't got to deal with the property or the asset afterwards, they may be willing to do it. So it all depends on a case-by-case basis per now. What you have to realize is that whoever that borrower is, if they can't pay, I don't keep them in the house. Like I'm not going to buy a note and just, let them stay in the house for free. I run a profit, right? Now, if I buy the note cheap enough and they can start making their existing payment. I mean, if they're behind like 2-3 years, they can't bring 2 years, but they can maybe bring 4 months to the table. If they can't bring 4 months to the table, I'm not going to keep them in the house. I'm going to say, listen, I'll do a deed in lieu and let you walk without a foreclosure on your record. 24 months, your late payments will be off. You can go back and buy a new house. But if you get foreclosed on 7 years, so it's better for me to give you some cash to walk away versus me have to go through the foreclosure process. That's going to hurt you long term. You don't want to do it. Does that make sense for you, Parnell? Does that answer your question? It all depends on who their lender is. Did you know who their lender was by any chance? Yeah, a lot of people got behind COVID. That's fine. But what happened though is a lot of people got behind, never wanted to start paying again. Okay, well, if you haven't paid for 4 years, what'd you do with the money? Have you been working? You know, some banks said, "Oh, we'll delay it for 6 months, and you got to bring 6 months to the table." That doesn't work. It's not smart. Okay, but that's one of the why we look at COVID now as being this, catastrophic event. That if they were up, on time prior to COVID, okay, we'll modify. But if they were behind prior to COVID, it's probably going to be a foreclosure most of the time. And no, I won't buy a note, do a deed and let the borrower stay in the house and do a rental. That's the worst thing you can do. If they can pay their mortgage, which is probably cheaper than rent, just doesn't make sense. It's better for them to move on and go somewhere else. All righty, Ray, we're back with our second half of Note Weekend here in June. And glad to have you guys all here. We've covered a lot of stuff already about how we find these deals, the types of notes that we're chasing, licensing requirements, how do you kind of collateralize them, stuff like that. Well, today's all about finding investors right now in this session. Session number 7 is all about finding investors. And for some of you, this will be the most valuable thing you take away from here. Remember, you're not going to learn everything about no investing in one afternoon class. It's a lot of moving parts to it. I think you maybe have. It's different than buying their real estate. When it comes to raising capital, it's very similar, but the way I teach it, it's literally one of the easiest ways to raise capital. Everybody that is watching this, listening to this, you are capable of raising $1 million in private capital in the next 90 days. If you just do the things that we do, you'll be blown away by how easy it is to find investors, okay? And I mean that from the bottom of my heart. Our one-on-one coaching students are raising millions of dollars of private capital for their deal flow, okay? So find investors to fund your deals. Pretty simple to do. Real estate investment clubs and meetup groups, that's kind of everybody knows. I'm going to go meet up with people, or I'm going to go to an investment club. Here's the problem with those areas. Yes, you will find investors there, but they're greedy, just like you, right? They want to make 10, 12, 15% on their deal. They want to do short-term stuff because that's what they've heard they can do. And that's great. But there's also more people looking for money at those places than there is actually money in a lot of cases. Okay. You can go jump on LinkedIn, type in real estate investors, and we've done that and systemized that with like octopus CRM in the outreach. Hey, I see your investor. What are you looking to do? We'll look keywords, real estate investor, IRA, SDIRA investor. We'll jump in LinkedIn groups. We'll look at different profiles too. You can jump on connected investor. You can look on bigger pockets. There's some things that we go into in our 3-day class that really help people find and raise capital through bigger pockets really easy through the keywords and posting specific keywords to look for, and then send them a pitch deck video to touch base with them afterwards and start that process, because it's a multifaceted, really 3, 4, 5 touch approach to raising capital in a lot of cases. But what we like is self-directed IRA, and you can find them at these different events that these self-directed IRA companies host. But we like to target public records. This is what's been the biggest bang for the buck. Now, there is a website called Netra Online, which basically brings all the county records, county websites together in one spot. You click on Netra Online, official public records. It pops up a map of the state of the country. You click on a state, you pick the county, then it gives you a listing of a website for the county appraiser, the assessors, tax, all sorts of things in the counties. And then what do? Well, this is a free tool. Most websites, most of these county websites are free. There's a few counties that will charge. Some allow you to search more than others. Some are very specific. They won't let you search by name, stuff like that. But if we go to the county appraisal districts, here's where the first bit of magic happens for you. Okay. You can also do the county clerk. We'll talk about how those two work for you in a second here. And people that have a self-directed IRA, okay? People that have a self-directed IRA with Quest, Equity Trust, Pensco, there's 50 different IRA companies out there. Some are bigger in different parts of the country. But like if I go to the Travis County Appraisal District here in Austin, Texas, and I type in Equity Trust or Quest Trust Company as the owner name, it will pop up a list of people who have used their self-directed IRA to buy a piece of property. When it's rental or land, it gives me the address, it gives me their mailing address a lot of times. Now, sometimes the mailing address is the IRA company, others, it's their actual mailing address. That's easy shooting when it comes to raising capital, because guess what? People have used their IRA to land, are smart, they're educated, they're using their IRAs in a passive manner. It's very, very easy to get these people to raise private capital if you follow up with them on a regular basis. Hey, I saw that you used your IRA to buy a property. Are you looking for more deals to fund? I've got deals. I'd love to talk. I like to network with other investors. Let's talk. Now, that's the appraisal district. Pretty easy to do. If you can search by name, that's easy to do. You can find hundreds and hundreds and hundreds of investors that way. Send a letter or postcard. There's a system that we teach in our 3-day class that's really effective. Okay. Not going to go through much of that today. That's what it's just simple. If you go now, there are counties in some states that won't let you search by name, like California won't let you search by name, Minnesota won't let you search by name, Maryland, Virginia won't let you search by name. Where else? There's another one I'm drawing blank, but most counties, like there's enough. Like if you go to Ohio, that's the land of Equity Trust. You go to all the counties there in Ohio, they'll let you search by name. Just type in Equity Trust, you'll find hundreds. And even some counties across America make it really easy to hit a download button. It downloads the whole name to an Excel spreadsheet. Easy to work. Okay. Beautiful. Okay. Now, the recorder's office, the clerk, that's a little bit more difficult. What you would do on the clerk is look for people who have lent money. So you're looking a deed search, same thing, Equity Trust, but doing a deed document search, and you're searching by, you can do a full 12 months. You might need to shrink it down to 6 months or 90 days, stuff like that. But same thing, it's going to pull up a list. You're going to need to click on a copy of the deed to see who the name is of the investor who lent money. Sometimes you'll get multiple on there, their mail addresses. That's a little bit more intense, needs a little bit more work, but it's also very efficient because these people lent money out of their IRA to somebody else for a real estate deal. So it's a much higher hit rate in raising capital from these investors by just touching base. You don't need a huge amount of lists. If you got 100, 200 names, and you're dropping a letter or postcard at these people and do it 3, 4, 5 times, you're going to raise $1 million, because here's the big kicker. The average balance in an IRA, okay, the average balance, so actually 67% of people that have an IRA have 150 grand or more. 67%. So you only need like 6 or 7 people with an IRA to raise $1 million. So if you figure 6 people at a 4% open mail rate, that's 200 people, basically. 200 letters, and 4% would give you 8 people. That's what you need to raise $1 million. And we see it done on a regular basis. Now, appraisal districts, you can search by multiple IRA names. Sorry, the 2 biggest are going to be Equity Trust, Quest Trust. Find the mailing address, find the account holder names, look for if they have any other property. So like if it says Scott Carson and the mail address says Equity Trust 17177 Park Row, Houston, Texas is the mail address, I know that's Quest's mailing address, right? So instead of me mailing a letter to them, I'm going to go to the county like Travis County and type in Scott Carson and see what else he has. And if there's a mailing address for a different asset, it's the same borrower, the same lender, that's who I'm going to mail it to. And I'm not going to mail it to the IRA company. They're usually not going to pass it on. But it's a great way to find if they're investing. Like I've seen people who have had 5 to 100 different properties. Like that's an ideal investor to reach out to. Maybe I don't need 8, I need 1 or 2. Okay. And then I could also take the name and go Google on White Pages or Spokio to find a mailing address. Or, just Googling that person on Google, I can find who they work for, if it's the same city, state. If I go to LinkedIn and find them on there, I can send them a direct message. I may not even send a postcard or letter at all. All right. This making sense, everybody? Is this kind of blowing you away a little bit? Some of you have heard me talk about this before. Some of this brand new. Like one thing that we do too is we take a property back or a property for sale. We'll do this in the same county and say, hey, we've got a deal for sale. Are you looking to buy a property? Or if we have to take an asset back that's ugly, we don't do the rehab, we'll reach out to IRA investors and say, hey, do you want to buy? We got a new property. Do you want to fix and flip it in your area? But this is, I mean, simple. Like there was a realtor down in New Braunfels that reached out to me and some commercial properties they're looking to raise capital for. So we'll just just go to the county records. You can pull up 150 people in Bexar County alone or Comal County who have invested in real estate. If you're looking to raise, $500,000, there you go. You need 2-3 people. Reach out to those people who are investing there locally. All right. It's not difficult. Mail them a letter, postcard, contact social media, and just start that process. Okay. Simple thing. Now, on the recorders, like we talked about before, same thing. Search for the name. You do a deed search to find their name. It's going to pull up a mailing address, the amount they lent them, plus the two things is great. You see the amount that they lent, or you do a release of lien, and they get paid back. That's a golden nugget there. Look for a release of lien in the last 6 months on an IRA investor. That's the amount they got paid off, and they've released the lien, so they have money to invest. Okay. And not only do you have the name of the investor, but you also they lent the money to as a potential funding source for you too. Mail letter, postcard, contact via social media. We've got our VAs that do this work for us. So it's pretty easy. It's to give you a bit of an idea. Like I pulled 2,500 names across the state of Texas in like the 10 biggest counties. We basically gave that with our VA. They found 400 names and email, found 400 contact information as far as emails. And now that 400 people, they're just getting drip marketed on a monthly basis. Hey, we got a deal available for sale. Or we're looking for funding idea. Are you looking to put your money to work? We also, one thing to do is if we get them to contact us, we'll get their cell phone number and put them in a SMS campaign. So like, then if I have a deal that's looking for funding, I can just send a text blast out to 1,400, 1,500 people and raise the money I need in just a few minutes. Okay. Now you can go out and buy custom lists. This is a little bit easier, but it's a more of a watered down list. It's not people that have a self-directed IRA. It's those that have an IRA just by themselves. Like I said, you can search by city, county, state. You can ask for a list of just people that have 150K or more. You can also buy a list of employees of the company, like when Halliburton was laying people off, or other people go, hey, I want to buy a list of everybody that works for this one company that got laid off with high 401ks. They can give you the list, and it'll be, pretty full list. Names, addresses, emails, sometimes phone numbers. Have used 2 companies in the past. Melissa Data, who we used to use, we like exactdata.com. And that's been a pretty good now. Like I said, it's a generic list of people that just have an IRA. They may not be real estate investors, so it's much more of an educational aspect I have to educate them on. But if I can get them at 6 to 14 cents a list or lead, most of the time they want you to buy $1,000 worth of leads. That's 15,000 names. It's going to take you a while to get those into your CRM or email campaign, but you can raise a lot of money that way, drip marketing, or even get a little bit more fancier by using like Facebook marketing and stuff like that too, but we won't go into that. Okay. But 16,000 names of investors in an area, you guys, if you market that, you got plenty of investors. You don't have to do anything else. Okay. Now, where can you post this stuff? It's good to post. What you want to post is start sharing. You want to start getting outside of the crowd. Most people aren't doing anything. Okay. Most people aren't posting. They might post on Facebook Marketplace once, and that's about it. That's not effective. You've got to post on a regular basis. I believe that the more you post, the more you cast the net, the more likely you catch a fish. Okay. Pretty simple. It is not difficult to do this. So like if you've got a deal for sale or a deal you closed on, post a deal that you've done. People like past experiences. That's if you don't have a deal that you're currently working on. If you got somebody that's working on a deal you're friends with, share their deal. Hey, I got a deal we're working on. Hey, I got a property that my friend Forrest is trying to sell, whatever it might be. Now, here's a video of a property that we sold last month, or we're working on stuff. Pictures are really great until a picture. Videos do even better. I'm always amazed that realtors just post like one picture of a property. And that's all they post. I'm like, that doesn't really tell the full picture. Video is what you need to do. That's why if we walk a property, we always take a video of it. Always do a walk around video, then more photos, because that's such valuable marketing. It adds experience. It adds a whole layer to the story than just what the property looks like from above. Never mention safe or guaranteed. Those are two big bad words. Okay. Never mention safe or guaranteed. You can say it's secured by real estate. That's one thing. Okay. I like to create a short pitch deck video, usually about 10 minutes, talks about my experience, what we're doing, what we're focused on. Our one-on-one coaching students, that's what they've been doing. That helps them raise capital because it answers most of the questions. And then when they mark it out to via a postcard or letter, there's a QR code or a link for them to go watch their pitch deck video. That raises capital pretty easy. But the idea is just to post deals, post past deals, post foreclosures. We've seen a lot of success recently reposting what others have posted about, like foreclosures, taking that picture of that property, me doing a short 1-minute video about the deal, the specifics, and then posting it across all our socials. All right. But here's the thing. Don't be afraid to share about you, your focus, your background, your team, your vendors, any deals that you've completed or done. It doesn't need to be notes. Okay. Yes, it helps that you're doing some notes, but if you don't have any notes you close on, share deals you fixed and flipped. Share property. If you've ever bought a piece of property, you're a real estate investor. Share it. If you're making an offer, hey, I'm making an offer on this 26 acres. Okay. Or I'm making an offer on this 5-acre farm. Or I'm walking around this triplex on Lake Mille Lacs up in Isle, Minnesota. All right. Or I'm making an offer on this, West Palm Beach condo. Whatever it is, share and share and share. Do it a little bit each day. It goes a long way. It's like planting little seeds. Okay. Now, when it comes to qualifying investors, not every investor is created equal. Okay. There's questions I like to ask them. Are they currently investing in real estate? Now, if I see that they've got a self-directed IRA and they've lent or bought, that's a pretty easy slam dunk. Now, if I bought the list from Exact Data, then I need to ask that for sure. Are you currently investing in real estate? Are they accredited or sophisticated? How much are they looking to invest? How much are you putting to work? Like I had a student who's all excited. Somebody called him and said, hey, I'm looking to invest. I've got some money in my 401k. They never asked the amount. I'm like, you got to ask them how much are they looking to put to work? 50K usually needs to be a minimum of that. All right. If they say this 5K, but you've got a deal that's 50K, that doesn't help you. 5K is not enough. 5K is more of a pain in the ass than anything. So you want to set some minimums. 50K, usually when you start off, you'll probably bump that to 100K as you get going forward. I wouldn't go below that unless they're close friends and family. That's the only exception I'm going to make. Anybody else, make sure they've got to bring 50. If you don't have it, market more. Don't take 10K, 10K, 15K, 15K. That's a sure sign you're pooling money, and that's not a good deal to fund one note. One investor per each note, not 2, 3. Now you can partner with that investor. You could bring half of it and they could fund the other half and you partner on buying that deal. That's a different thing, but don't be pooling money from other people. Okay. How long are they looking to invest? If this money's sitting in their IRA and they're doing anything, they can't touch it. So a 2 to 3 year period is short term. Most people think when they hear notes, they think 30 years. Well, we're not doing things for 30 years. We're doing 24, 36 months for the most part. Okay. Are they active or passive? If they're an active investor doing fix and flips, they're probably going to high returns. Some guy came to me and says, I got $500,000 I want to put with you. I'm like, okay, what kind of return are you looking for? 15%. I'm like, not going to happen. He goes, what do you mean? I know you can get those type of returns. Yeah, I can get those type of returns. I'm doing the work. If you want 15%, go do the work yourself because I'm not going to give up that much. No need to. There's plenty of money out there. Okay. Plenty of money out there. What kind of returns are you looking for is so important. Oh, I want, I'll be happy making 8. Great. I can give you 8. Or what's this money been doing? It's been sitting there making 0. Okay. How long has it been sitting there making nothing? 4 years. I'll give you 6%. Well, I want to make 15. Yeah. But what happens is 2 different things. You've been making 0. I'm going to give you 6 or I'll give you 8. I'm not going to give you 15. 15 is reserved for those that are going to hustle. And if I'm doing most of the work, the finding, the workouts, all that stuff, money is really not the gold. He who has the gold makes the rules, ladies and gentlemen. And in most of the times, it's not the actual money, unless you're desperate and depressed. If you've got a deal, that's the true gold mine. Okay. And then we always make our potential investors, even fill out an investment questionnaire. We provide that in the 3-day course. It's 15 to 20 questions they ask about some stuff. They need to fill that out before we'll proceed going to the next step. Now, investors that you want to avoid are people that are unfamiliar with real estate, brand new to it. That's a bigger pain in the ass. People wanting short-term, well, I want to do 6 months. Well, that's too skinny a deal, a time frame, and too high an ROI. Like I said before, you really want to stick to $50,000 investments and above. People who talk bad about it, go look at somebody's social. What are they saying bad? If they're sue happy, all right? They bash negative people. Guess what? You can do all the work. If you promise them 12, but you give them 11.9, they're going to be mad at you. Not worth it, okay? Ask for references from somebody. Hey, who's your attorney? Have you done business with other people? Can I have references? And they may find that funny. Like, what do you mean I'm giving reference? Well, if you've partnered with other people, I want to talk to them. Make sure it's a fit. It may not be a fit, you and me, and that's okay. We still part as friends, but you have to realize, ladies and gentlemen, you are interviewing that investor just as much as they're interviewing you. Don't be afraid to walk away. Trust that sixth sense. The only times I've gotten issues is when I didn't trust my sixth sense and I went against it. There's times I shouldn't have. I've had people come in and fund deals that I should have never done. Should have just marketed a little bit more. Okay, you're going to get sued at some point. It happens. You do enough deals, you will be sued. It happens. Part of real estate. Okay. A lot of people getting sued now with what's going on in the market, stuff like that. But the biggest thing is, ladies, is stick to your guns on this stuff. The credit investors, sophisticated investors understand things will happen, and all they're looking for is a solution of some sort. Okay. All these syndications that are in trouble are basically invested people that never pulled the trigger before. Okay. What I like about no investing is one, you can go put a syndication, put a fund together you want, but you're not going to do that until you've raised a couple million. So go find one investor, fund one deal. If it makes sense, it's going to make sense on it. There's a lot of ways to make money on it. Set yourself up for, I don't make quarterly. I don't make monthly payments. If it's a performing note, great, we'll make quarterly payments. If it's a non-performing note, we don't make quarterly payments until we get the borrower back on track. If they don't get back on track, then we pay it when we foreclose and sell the asset off. Okay. Always require your investors to fill out the investment questionnaire or profile sheet, send you a pledge letter or email. Okay. And it's pretty simple. Pledge letter is just an email that says, hey, I'm attaching my proof of funds from my 401k or self-directed IRA. It shows $500,000. I'm pledging $50K to do note deals with you. They won't return those items. Guess what? They're not going to fund. And they might need to open a self-directed account with a trustee. They may not have a self-directed ID. Great, set it up. It may take a week or two for them to get set up. It's going to take 3 days at least to usually, if they're in a stock fund or like Scott Trade or Fidelity, it's going to take at least 3 days to sell out of those funds into cash. And then it may take another week for them to wire the funds and things to get set up. If they're doing a rollover, it's going to take 6 weeks in some cases, because most lenders won't do a wire transfer. They're going to send a paper check out on a rollover, which is just shitty. Okay. But anyway, this is very important. Have paperwork created by an attorney. Make sure you're having funding agreement reviewed. Put some things in there for arbitration, some clauses. I have a penalty if they cancel. They want their money back before the agreement term. So if it's a 1 year agreement, they want their money back in less than a year, there's a 25% penalty. They got to give me 90 days to refinance them out. I'm always glad to have the CPA or the attorney review. They're going to screw shit up because they're not knowing what the hell they're doing. Okay. Feel free. You can review it, but they're probably going to screw shit up. It just is what it is. Attorneys have a notorious way of messing shit up because they want to throw their weight around, and a lot of them are just freaking idiots. Okay. Always use agreements. So even with your family members, it outlines what happens when things go wrong. Can't tell you that's so important. And most investors can't make 6% or greater. If they were, they'd go out and do it themselves. Otherwise, if it's sitting there making money, not making any money, don't give them something that they're not going to give themselves. 66%. Okay. Actually, it's not 60, about 40% of all money in IRA is sitting there making 0%. They've rolled it over. They want to do something, but it's just sitting there, not doing anything. I mean, who hasn't had an IRA somewhere, they rolled it over or something like that, sat there and didn't do anything, you forgot about it, you got to put it to work. Realize, hey, I'm going to put it to work for you, but I'm going to give you, I'm not going to give you 10% or 12, I'll give you 7, 8%. If money's making 0, 6% is an above average return. Keep that in mind and use that as a negotiation tactic when you're looking at that, okay? Now, when it comes to payments, I talked about this. Set up your payments to be quarterly, avoid monthly. If they want monthly, don't do it. It's a bigger pain in the ass. Plus the fees will be nickel and dime. It's like a million paper cuts. Set up an online portal for tracking help. That's like Basecamp, Dropbox. There are a whole variety of different Podia, different things you can do. Google Sheets, something that you share the collateral files, share what you're doing, share a message. Never, ever pool money investors together. One investor per asset. That's not including if you're contributing. But never bring in like 4 different investors. Now, if you got like 4 family members that want to pool their money together, make them go get an LLC and have whatever they invest into that LLC, that's your percentage. Then you're borrowing the money from the LLC, not from them individually. That step alone can keep you out of trouble. Okay. Trust your instincts. If you don't like the individual, you get a bad feeling, they're an asshole or something like that, you don't want to jump in an investing bed with them. Okay. And one thing I say, listen, and if somebody says, oh, I got 200 grand, great. Let's start off with 50 grand or 100 grand. Let's make sure it's a good fit. If it's not a good fit, then no biggie. We'll just part ways and leave as friends. But you're going to be with this, invest with this people for at least 6 to 12 months, if not longer. So keep that in mind. One of the biggest mistakes I made was not communicating on a regular basis. A lot of things that got me in trouble. The more communication you have, the better. That's why I like a Basecamp or something. Like you go in and post updates to it, and everybody gets alerted to it. Whether they read it or not, that's not up to them. It's up to them, but it makes it a little bit easier to do. Okay. Makes sense, everybody? Have any questions about that before we dive into the marketing side of things? Raising capital is actually pretty easy. You know, you're going to find that if you do market for money, you're going to get more money. Most people have plenty of money. They don't have deals because they're just not marketing for deals like they do for capital. Okay. All right, moving on. All right, let's go through some different ways of note marketing, ways to market your notes, your note business, stuff like that. This is really a lot of fun. It's one of my favorite sessions of that. 80% of sales are made after the 5th contact. You already heard me talk about that when contacting asset managers. It's the same when it comes to raising capital. Expect to post regularly and often. But here's the thing. There are tools that you can use to help you automate this. You don't have to do this during the day or as you go. You can literally do it and automate it or set it up where you do it once a week and it posts weekly for you, okay? You can use buffer.com. Hootsuite's a little bit expensive, but buffer.com is pretty easy to use. You can go and post the same thing anytime, scheduled to go live, scheduled to go out. Very easy to do about assets or deals you're working on. There are 3 most important things to use in today's market. In today's marketing, these are the 3 most important things. First thing is email. You got to have a CRM. I like keep.com. They're not the cheapest, but they have more bells and whistles that you can use to make this easy for you to do. Okay. Cheap is not, you do get what you pay for. I'll tell you that right now. Okay. Some CRMs are cheap and they suck. I've used Keep for, I don't know, about 10 years now, and they keep coming up with new things. Okay. LinkedIn, you got to have a LinkedIn profile, and you can use a service called octopuscrm.io. It's another tool. It's like $21 a month to help you automate and making connections and reaching out to people through LinkedIn. It's well worth it. That's how we went from 6,000 to 30,000 connections on LinkedIn is Octopus. Okay. And we have basically the free account or the mid-grade account, whatever. And then you got to realize and embrace video marketing of some sort. YouTube is the number 1 because it's the number 2 search engine behind Google, but there's a whole variety of video things, Facebook, LinkedIn, Instagram, TikTok. It's the one thing we've been messing around with by posting, almost daily videos and some sort of real estate article or deal flow. Works really, really well. Okay. Now, email marketing, like I talked about this, is still the number 1 ROI for marketing. You get for every dollar spent, $44 back. That's a 4,400% ROI. You can't beat that. That's from the American Marketing Association, not me. So choosing not to use email is literally just being stupid. I'm sorry. I'm going to call a spade a spade. If you're not emailing your list on a weekly basis, because you're lazy or you don't know. So I'm going to say that you don't know. So now you know. You need to start marketing to your database. That means pulling a list of business cards. Going out and networking. Anybody you've sold a property to in the past or got a listing from, put them on your database. It's so important. It's the one thing to touch base. These free, that's what everybody's all scared about, like TikTok going away, because people have built these huge followings, but they don't have their email. They don't have a true way to contact them outside the platform. Okay. Connect with people. One thing that I do on a new platform, if somebody connects with me, I always say, hey, thanks for the follow. What's your email? So I can, if you want to, I can add you my email list. And if they don't respond, that's fine. But a lot of them respond. So I build that relationship because I'm building something valuable. Okay. You can use Keep, Aweber, MailChimp, whatever. Remember, we talked about the marketing to your asset manager database. You can do the same thing to your investor database, sending the same thing Tuesday, Wednesday, or Thursday. I also have very good success sending out on a Sunday night email. That's right before people go to work. All right. I don't send Friday afternoon, but send something valuable. Why do I send it Sunday at 7 p.m.? Because that's when people are usually looking at their phones, thinking about Monday. So we announce a new podcast episode or a new webinar, something on Sunday nights. It's the number one open rate email for us. What I talk about? You can talk about when you're brand new. There's 4 basic things you can talk about. Guess what? Every month has a holiday. Merry Christmas. Happy New Year. Happy Valentine's Day. Happy St. Patrick's Day. Happy April Fools. Happy Mother's Day. Happy graduation. Happy Memorial Day. Happy Father's Day. Happy 4th of July. Happy back to school. Happy Patriots Day. You get what I'm saying, ladies and gentlemen? Happy Halloween. That's 1 week. That's 1 email. So at least once a month, you can wish somebody a happy holiday. At least, okay? Next thing, if you're going to a meetup group somewhere local, most of you are going to have an audience that's more local, right? Mine's nationwide because I traveled so much. Okay. So maybe you're going to a conference. Maybe you're going to a meetup group. Hey, I'm going to my local real estate investment club this Thursday night. If you want to join me, hey, shoot me a message. I'd love to buy you a beer or an adult, or a cup of coffee. We can talk about investing. Okay. Maybe you got a personal event, something come up, vacation. Maybe I would advertise the vacation after when you get back with photos from the vacation so they don't know, hey, you're not home. I'm going to go rob your house. Okay. Personal event. You get a closing. That's another thing. Or celebrate a birthday. Like I posted a photo of me turning 47. I got all these comments about it. Good things. All right. Or even a little something like I went to Minnesota and took my mom to her first baseball game, or we went and, checked out Paul Bunyan and Bay the Blue Ox in Bemidji. It's just personal. It gives people like the fact that they can get a chance to know you. All right. Celebrate an anniversary, whatever, something personal event. And then of course, a past or present deal. The reason you want to get in the habit of sharing past or present deals is so that when you do have a deal that you need funding, it's not coming across the board like, I don't know you. Like, don't you hate that? Like, hey, I'm saying my first meal. I need you to fund this deal. Well, I don't know you from Adam. I don't want building a rapport virtually with you. Okay. This is part of the reason we like video so much, because it helps build rapport faster, but the email is just as important to keep that communication going. And we get a 35 to 50% open rate on our email databases. And I've got a big database. But I also notice when I haven't emailed in a week or two, if I fall off the wagon and don't send it, it's a slower open rate. I got to build that open rate back up by just staying on top of mind, present of mind with people once a week. Okay. Now, like I said, you're mailing your investor database once a week, asset managers once or twice a month. Okay. Now, LinkedIn, leverage this. This is really the professional social media. Take the time to complete your profile 100%. There's some cool things you can do to stand out. Like if you're looking for notes, put note investor, real estate investor. It's still the most professional social media out there. You got to use it. Easy way to find investors, bankers. Like we talked about, octopuscrm.io. Go check it out. It will help you automate reaching out to 20 to 100 people per day. Okay, I can create lists in Octopus CRM, asset manager, podcast host, note investor, IRA investors, and find groups and send connections to 20 to 100 people a day. Where else are you going to do that? Probably nowhere. Okay. But I can start my morning off by logging in Octopus, start the connection, and automates it. Great. I come back, go for a walk, come back. I'm now connected with 100 new people who've subscribed to my profile or follow me. Beautiful. Only 3% of LinkedIn users post daily. So if you post something, even post on the weekend about something, you're probably going to get a lot of feedback, but grow it. Use Octopus. Just getting on there, if you only have a 500 connection, only getting on there and talk about what you're doing isn't necessarily going to grow it. You need to be actively reaching out to investors to grow your database. Okay. Join and post to groups, although a lot of those are dead. Still posting in some of these investment groups. They've got, you can be in a connection in a group with somebody and then connect them. Say, hey, we're connected through this group, and it's often a warm market. And LinkedIn will allow you to import up to about 1,000 email names into LinkedIn if you know how to do that. And we show you how to do that in our 3-day course. Okay. Video marketing. Look, this little thing, these phones, as long as you have a flip phone like my Uncle Vern, you still got a flip phone. If you're not Uncle Vern, then you've probably got a phone that does video. And you can take a quick video when you're walking around a property, going to a meetup. Look, post it to YouTube. It's the second largest search engine owned by the number one search engine. Okay. I use TubeBuddy. It helps me grow because I can come up with keywords. One of the most important things about YouTube is just uploading the video. You got to have a nice title, description, and then tags. Those are all important. Yes, a thumbnail is important to get people to click on it. But with what YouTube does now with them auto playing the video, it's important to get stuff in one thing. Short videos do really well. Actually, YouTube is doing this whole short thing where it's a minute or less. It promotes. I mean, we've done shorts that average 400 to 500 to 1,000 views. We take that same video and throw it on TikTok, and we're averaging 400. I got one video is 131,000 views on an asset. Okay. 10, 15. I think one posted yesterday is up to 5,000 about Austin being overpriced. Okay. But that's posting that same video that I upload to YouTube. I upload to TikTok. I upload to Instagram. I share it everywhere else. Remember, I'm casting a net, not just posting in one spot with one line. If you've ever been fishing, think about this. You throw a cast net out, you're going to catch more versus just throwing one line in the water, waiting for that one line. What's to be more efficient, okay? You can do Facebook Lives, LinkedIn Live, all this stuff is really working with shorter videos, 5 to 10 minutes to share what you're doing, okay? Now, we also use long-form video. By long-form, it means it's videos that are like more than 10 minutes long. Case studies, deal flow. Our buddy Cal Ewing's doing a no deal of the week he's breaking down, and it's helping him grow his channel, helping him grow his investor contacts. It's helping him build more rapport with investors. Okay. And you don't need any fancy software. All the software and stuff you need is on your phone for the most part to upload it and tweak it through. They're all mobile enabled. Okay. We believe in something called the marketing octagon or content octagon, where you take one piece of content and reshare it. So, like if I take a photo of a property, I can then reshare it. I can create a small little video about it, talk about that deal case study. I can upload it to the link to Buffer and have it promoted across Buffer, or Twitter, or Facebook. Have it go the same time across all those platforms or staggered. I can schedule it so I don't have to worry about doing it live. Not everyone that you know is on every platform. And we all know the platforms don't share your message or share your content with all your followers. They just don't do that. You're lucky to get 1 to 5% on Facebook, about 11% of YouTube. TikTok does a better job, but it's starting to. LinkedIn's about 10%. So the idea here is to share it so that you have a cross-pollination of somebody seeing you once, or they see you twice and like, oh, you're everywhere. I want to see what you're doing. Okay. Cross-promoting means more hit, more likely to get something to happen. It doesn't take that much to do it. Posting at lunch time, 3 p.m., 7 p.m., and 9 p.m. also works best because that's when most people are on their phones. Okay. Start with one new platform, post, and then share it to the next platform week 2, another platform week 3. And you'll soon realize that, like, I'll give you an example. It takes me a couple minutes to record a 1-minute video. I post it to YouTube as a YouTube short. I then post it to TikTok as a video. I then go and post it to LinkedIn. I then go post it to Twitter. I then go, to Twitter or X, what do you want to call it, to Instagram. And then I also go share it to Threads or Reel, or whatever like that, and post it to my personal and my business. I can take one piece of video, 1-minute video, and share it like 10 spots. Okay. That's how we basically carpet bomb our social media with content, but it also leads to people paying attention. This is why I don't have to travel. I can work from home. I ain't got to fly out to do stuff because we got people in our database that will do a lot of stuff. Does that make sense, everybody? It's a kind of a quick social media marketing aspect, but it's something you need to embrace as investors. It's the 21st century. If you're not going to embrace this, you're going to still try to do like how you used to do things beforehand. Guess what? You're going to be out of business. You're going to struggle to get shit done. Why struggle? Be smart. All right. Let's move on. So one of the big questions I get from people is, how do we structure these deals as far as business entities go for you? Can I buy in my own name? Yes, you can buy in your own name. It's not very smart. So here's how we structure your note business. You need to use entities. You can use LLCs, trust, S Corp. There's a variety of ways, but you want to do it in entity. Do not do it in your own name. Okay. And I don't like to keep more than $1 million in asset values in any single LLC. So you're going to have, you can start off with one LLC, but make sure that LLC is not your other business. If you're doing something else, make sure it's a separate LLC. It just does not make sense to, oh, I don't want to pay the $300 register or the $800 register. Tough shit. It's business. Do it. Okay. Same thing. If I have an investor brings 250 or more to the table, we use a separate entity just for their deals that we're partnering on. Okay. You want to keep your deals or assets separate from partner deals. That's a separate LLC. You probably want to keep your performing notes separate from your non-performing. If you take any rental properties back, you may want to keep your rental portfolio separate from your note portfolio. Actually, you should keep it separate, not want to. Commercial assets, they get their own LLC. If you're going to be doing like a management company or doing some marketing and stuff like that, you want to probably do that in a separate LLC like I do. And then, of course, good asset protection is having like a management company that manages your assets and manages your other LLCs through like the Rockefeller strategy. It's important to do this. It's one of the most valuable things you can do. Yes, you can just use your self-directed IRA if you want, but it's not smart to fund in your own name or your IRA because you can search that way. It's good for asset protection to do it separate. You don't want the Consumer Finance Bureau coming after you individually. It's better to go through your LLC. Some actual counties out there are suing trustees for back tax, like Wayne County, which is in Detroit. If somebody isn't paying their back taxes, they're actually suing the self-directed IRA company. So this, like, Quest will not let you buy a note in Wayne County in just your IRA. It's got to be through your IRA LLC. Okay. Same thing. If you're going to be funding or using joint venture partners, get a separate LLC to stuff that up. You may, if you've got a big balance in your IRA, it might make sense for you to get checkbook access. So it's an IRA LLC. It's separate from just funding through some things. That's going to cost you probably around $1,000, $1,500 to set that up, but it can be worth it for speed of it. But it's also that extra asset protection. Okay. You can use trust. They're not, if it's something you're going to hold for a long term, trust all day long will work fine for you. If you end up foreclosing and take the asset back, I would just put it in a separate LLC. Just makes it simple for you. Okay. You do need to document things. Having an LLC is just not a trip to the Secretary of State and getting a tax ID number. You need to document transactions, contracts, funding off agreements, offices, vendors, partnerships, leases. There are a whole variety of things that you need to document. It can seem like a lot. It often gets, brushed under the rug. I would highly recommend that you use Laughlin and Associates to set up your LLCs. They're great at what they do, over 50 plus years of experience. About 95% of our students use Laughlin for their asset entity structuring. They just do a tremendous job. They've got a corporate veil protection plan that will help you out too. They'll help you with monthly tracking and documentation of your deals. And they have also with other asset protection stuff that you need to set up: wills, trusts, living trusts. Some of you guys will have sizable assets or estates that you need to put away so that you're not leaving a huge tax burden to your kids and family. They do a biannual event called Magnify Your Wealth. They just had one in San Diego a couple of weeks ago, so the next one's probably not till November. Well worth going to. Go to magnifyyourwealth.com, or you can watch the video that we do with Aaron Young. He's a buddy of ours, by going to Corp Veil Protection, bit.ly/Corp Veil Protection, and take a look at it. And it's well worth it. If you're older, you've got an estate of some sort, they'll literally be honest with you. Hey, you need this or you don't need this. There's other companies out there like Legal Doom or Anderson Advisors often will try to get you oversell you on products. That's not what these guys do. They will look at it and say, you need this. This is what you need. And maybe you need this, but this is really all that you need right now. And they're very familiar with note investors. They know exactly what our students are doing, and they're really great at setting stuff up for you. Okay. You can go to corpveilprotection.com to get signed up for them, and or to schedule a phone call to talk with Brent, Megan, or any of the team over there. All right. All right, let's go through different exit strategies here, ladies and gentlemen. There's 10 basic exit strategies that you'll kind of dive into. Or 10 ways to skin a note, as I like to say. Longer description of this video, of the exit strategies in this video. You can take a look at it. You can, yes, if you buy a note or you get a note under contract, you can flip it. You can wholesale it, flip and contract, just like flip wholesaling property. And we've wholesaled notes before, but you end up leaving a huge amount of profit on the table. If you're going to take all that time to market to find a wholesale buyer, I would put that money in time to work to find investors to fund your deal, so you're making most of the deal instead of making a small wholesale fee. Wholesale fees might be $500, $1,000, 1 to 3 points based on the funding amount. You may need to do a double closing, which will eat into your fees. Then you'll have to set up an escrow account, 2 different contracts, or you can just do a signed fee funding agreement when you trust the buyer. There's different ways. We go through this much more in depth than a 3-day workshop. Okay. You probably will need to use a real estate attorney when you're starting off. That can cost you $500, $750 to set up an escrow account. And here's the thing: good wholesalers know their deal and they know how to market what makes sense. When we want to flip notes, we know what goes in the deal. We do some of our own due diligence. We know the value. We know what the exit strategy is. We know potential ROI and things. And that's why if we do, we can market stuff. But if you're just trying to throw a list out or be part of a daisy chain where you're a joker broker, that's not a good thing to do. Okay. Now, when you say you buy a note and it's non-performing, the first strategy is always to get the borrower to start paying again. Okay. And this is where they start paying on time on a monthly basis. Your servicing company is going to do outreach. Hey, can you start paying the loan? Can you start paying on time? It's the first thing they're going to ask. Okay. This is why it's worth paying a licensed servicer, $90 a month. If it's non-performing, it becomes performing, it's 35, 15 in some cases. They're going to collection of payments. They're going to apply it to the right month, the most latest month. They're going to help you with the structuring of this stuff so it's working properly. They're going to help you with the borrower outreach, right party contact, especially if you have a job. They can call multiple times during the month, during the week to reach them out. And you instruct the servicer. Okay, here's what I'm looking to do. We bought this note. We're willing to do A, B, or C. Okay. Oftentimes, especially what was happening during COVID, is they would do a forbearance agreement. Okay, you haven't paid in 2 years. We'll take the 2 years and put it to the back end of the amount if you start paying on time, or bring a little bit extra and start paying on time. Pretty common. That's the normal thing. Most servicers, once the borrower is paid on time for 3 or 4 months, they'll consider it performing and drop your monthly payment from 95 to 35. Okay. If the borrower can't pay the existing payment, then there's going to be some sort of loan modification or some sort of change to it. Now, what does that mean? I don't go straight into loan modifications. That means because if you modify the loan, you don't need to originate a new one. Basically, if you're forgiving debt, changing the interest rate, that's permanent. Once you do a modification, it's permanent. Borrower signs off, it's permanent. If they don't pay on that mod, guess what? You restart the foreclosure calendar, restart the time to foreclose. So what we do is a trial payment plan for at least the first 12 months. Come in, you make a payment, make 12 months of on-time payments, then we'll modify the loan. Then we dangle that carrot at 12 months. Okay, bring in 4 months of payments, then we'll do this payment, do that for 12 months, then we'll forgive balance or change the interest rate. We'll do whatever, but you got to prove to me that you can pay. I'm not going to give you something you don't deserve. Okay. You do a payment plan with a lump sum or extra payments, limited time, usually 12 months. The reason we do 12 months, because if you modify a loan before 12 months, the IRS wants to tax it as a short-term capital gains, and you don't want to do that. Okay. And then we're going to tax you on the balance of the loan mod. And that's what they want. And then you get a third party to come in and evaluate what you paid for it plus what's coming into paying the ass. So just do a trial payment plan. Then you're only taxed on the income that comes in at 12 months. And then after that, it's a long-term capital gain. You're much better off. But you can do a variety of things: just balance, forgive, reduce back, all sorts of good things. Never go straight to loan mod. Like I said, do a trial payment plan for 12 months, unless they bring a chunk to the table, and then go from there. The borrower will need to sign the trial payment plan, and they'll need to sign off on the loan modification. Sometimes they'll just start paying it without signing it. It's better to get signed so you have that. It's more valuable to sign loan modification trial payment plan if you're trying to sell that note later on. Okay. Sometimes they'll just pay off the loan. Okay, but borrower will pay off the loan. You can do a reduced payoff settlement. We do this several times. Hey, if you pay 50 before the end of the month, we'll forgive 10 grand or 15 grand or whatever. We'll do a payment plan over 90 days, pay a third, a third, a third. Now, if they don't pay the full thing off, guess what? We got 2 lumps of sum. Then they'll start paying monthly again. Okay. They're not going to go get a bank loan. That's the biggest thing to realize. If somebody tells you I'm going to go get a loan from a bank, it ain't going to happen. Okay. Most of these are going to be primary occupied. A bank's not going to give a loan, or hard money lender is not going to give a loan on primary occupancy. Just not going to do that. So if they are going to go cash out their 401k, great. where are you going to get the money to do this? Do you have that in your balance? Okay. If you don't have that in your balance, you're not going to do it. Let's just go move to the next step. Okay. If it's an investment property, they may be able to get a hard money lender or an investor come in and do it. Most of the time, they're going to cash out the retirement if they got to do a payoff. Okay. And you're going to handle your payoff or settlement statement with the servicer, where they're going to pay the servicer directly, and then the servicer is going to pay you wire to your account on the 4th or the 15th of the month. Okay. If the borrower pays you, you're usually going to get payment by the 4th or 5th, and then middle month, 15th. Okay. If a borrower can't pay and can't pay it off, you may do a loan assumption where they can let somebody come in and take over payments. Yes, you can allow somebody to assume the loan. Happens all the time. People forget about this. You're the bank. You can allow it. Okay. And maybe it's a family member, a friend, maybe it's a potential investor that wants to take it over subject to the existing financing. It's not creating a new loan. You're not creating a new loan. They're taking over the existing loan. But so we still want them to fill out a loan application to make sure they can afford it. The last thing you want to do is go from one bad borrower to another one. Okay. We're not refinancing. So when there's no MLO required, no reason to go through Dodd-Frank compliance. It's still the existing loan that was once original Dodd-Frank anyway. Okay. You want to keep your existing payments, terms, all that good stuff. Borrower can quick claim it to a new note payer. Pretty easy. Okay. If they can't pay, don't have somebody to take it over, can't modify it, then you also allow them to do a short sale. That's where they owe more than the property's worth, and you allow them to sell it, and you basically take a short. You know, legal balance is 200. You bought the note for 100. I'll let you sell it for 150. You know, if the house is worth 150. Okay. You are the bank. You have to approve the short. Okay. I always tell them if they're going to sell it on a short sale, then they need to have the realtor listed at 85% of the fair market value they must. Don't list it at full value. That's the stupidest thing you could do. Unfortunately, some realtors are not bright. Oh, we're going to list the short sale at 100 value. No, 100%. Nobody wants to waste time negotiating with a bank that can take 60 to 90 days or longer. Okay. Listed at 85%, that 10 to 15% discount will get foot traffic in the door, and it'll also oftentimes lead to a multiple buyer situation where now instead of 85, they get bid up to 80, 90, 95, and you're taking less of a short. But that 85% is to get people going. Now, if they don't have any foot traffic after the first like 3 or 4 weeks and you've listed 85%, then you need to move to doing a deed in lieu or something. Okay. You also want to make damn sure that appointments to see the property are not structured around the borrower schedule. They got to be able to show it at any time. The borrower's going to be a pain in the ass that we're not going to do this, and we're going to move to a deed in lieu or consent to judgment and go from there. Okay. If I'm going to bleed, everybody's going to bleed. We'll often reduce the commission to the realtors to 4%, maybe 5%. It all depends what's going on. If we don't have to take a big short and they can bid it up, great. We'll pay a full 6%. But we start with that and we move on. Okay. Like I said, if there's no showings in 2 weeks, it's not going to sell in a short sale. Then we need to move on to have you deed the property over to us or do us consent for judgment so we can finish up and cash for keys. Okay. Now you can, if you say they owe 200 and you're able to sell it for 150, you can 1099 the borrower for the difference. I don't usually do that unless they're paying the ass. I'm not going to send them a 1099 for 50K. Yeah, you're supposed to do that, but yeah, I'll do that when I have people have been really big assholes. In most states, it's a one action state where a lot of states where the bank can only do one thing. That may be a foreclosure or one action. They can't go after them for the rest. Okay. A lot of banks in 2010, they would do a short sale, but they would ask the borrowers to sign a second lien. That's your second lien. And I would say, no, don't do that. It's one action. You foreclose for it, foreclose. Take your one action, but I'm not going to sign on an unsecured loan. Okay. Next step, question here. Somebody. Thanks, Forrest. Take care, buddy. I'll talk to you on Monday. Next step is if the borrower can't pay, don't have somebody to buy the property, can't modify it, then it's doing a deed in lieu, or we call it a friendly foreclosure, like cash for keys. This is where they don't have a second lien. It's only the first lien. You're letting the borrower basically walk scot-free. You know, they deed the property back to the bank or you, the lender, and you're allowing them to move out. You're forgiving them the debt. I don't accept the deed in lieu until they've moved out of the property. And I'm not going to give them cash for keys until the very end. Now, I have done this where, like, okay, we'll have you sign a deed in lieu. I'll give you 2 weeks to move out. I'll give you $500 to sign that deed over to me, and I'll give you the remaining $1,500 once you moved out of the property. But the property's about to be clean, swept, clean. It can't be trashed out. Okay. The great thing about a deed in lieu of cash for keys, it avoids a foreclosure on their credit, which will haunt them for 7 years. If it's just late pays, it's just 24 months, and that's not a big deal. Okay. You always need to pull title, do a title update to see what kind of liens are on the property. Very important, because if there's a second mortgage on the property, you don't do a deed in lieu, because now that second, the minute you accept that deed in lieu, that second now jumps to first lien position, and that's not a good position to be. So you always want, if there is a second, to do what's called a consent to judgment. It's a different document. Basically, you can show that the court say there is a lien, there's a lien behind us, the borrower is consenting to a judgment for the first amount, so that we can go ahead and expedite the foreclosure on the second. Okay. Always take internal photos, always pull title. Okay. If there's a borrower who's willing to do this. Okay. Of course, you can always sell the asset to another investor. If you've bought the note, done some workout on it, figured it out, and you don't want to go through the long foreclosure process, maybe just sell the note to another investor. This happens. You've created value in this deal by knowing which way the exit will or will not go. Okay. This works out when you've got longer foreclosure time frames with troubled borrowers or specific cities. Maybe you've got to cash out. Maybe you bought it so cheap, you took it down, and you're going to sell it at a 10% markup than what you paid for. It's still a good deal for you. Okay. Many of these funds that have notes available for sale, that's what they do. They buy it in bulk at 30, 40, 50 cents a dollar. They'll try to modify, get the bar to come to the table in the first 90 days. If they can't get the bar to the table in 90 days, some sort of reinstatement, modification, forbearance plan, or whatever, then they'll market the assets for sale and try to make a 10 to 15%, 20% markup, depending on what's going on. Because if they make 10% in 6 months, guess what? That's a 20% annualized return. It's pretty good. If they make 30% in 6 months, that's 60% annualized return. Okay. We'll market to local investors through our Facebook group, through LinkedIn, through other places. I don't usually will post. I won't post them to platforms like PaperStack, because it gets a lot of hits, but not a lot of closings. Okay. For somebody that supposedly has a big email list, they do a shitty job at marketing assets. Okay. I find more success in going to local meetups, Facebook groups, and marketing directly there, or reaching out to the presidents of these real estate investment clubs and saying, hey, who do you know who's a note investor, and contacting that investor regularly, or sending out my own email to 50,000 investors. Okay. Maybe market as a handyman special if it needs work, if it's vacant. There's some other things you do. I like to work with investor-friendly realtors to help them get a listing, somebody they can pocket listing to one of their investors who can take it over. Okay. Number 9, if you don't want to sell it, then foreclosures is going to happen. We talked about this briefly earlier. Non-judicials, like states like Texas, Georgia, it's faster, $1,000 to $2,000 to foreclose. If it's usually going to be 120 days or less. Judicial's longer, going to be really probably at 2,500 to 3,000 or more. Probably an average of 5,000 for the most part. Sell at the foreclosure auction. Either you sell it off because you're the bank, you determine the bid, so you tell your attorney what bidding instructions you want. So like if they owe more than the property's worth, I don't sell them to max. Like I'll give you an example. They owe 150, the house is worth 100. I'm not going to tell them to make their bid 150, because then I'm going to take the property back. Okay. Now, if I want to own the property, that's different. If I bought it at 60 grand, I'm going to tell them, hey, start the bidding at 75, 80, and have it go up from there and see if we can't sell it. Because then I can make my 20, 25K, not have to do any work, let somebody else do the rehab, remarketing aspect of it. But my maximum bid can only be what I owe. So if there's a lot of equity, then I would say, hey, they owe 150, but the house is worth 200. Then I would say my maximum bid is the 150. Okay. Your attorney, you work with your attorney, talk about that, get a realtor to pull comps, as is value, stuff like that. If you don't sell it at the auction, guess what? You just took it back and now you own it as an REO. Now then you'll have to finish the eviction, the rehab, and go that route. And it can be valuable. It may take a little time, but the foreclosure is going to basically wipe out everything except property taxes. It will wipe out a lot of the HOA fees too. In specific states, there are some things, and you buy the note and foreclose, and then when you sell the asset, you've got to pay the HOA usually 1% of the original sales price back when it was purchased. Okay. If you take it back, make sure you slap a lien on the property for the amount that your investor gave you. After the foreclosure, it's now an REO. There's no liens on it. Go slap a lien on it to protect your investment and your equity. There are fraudulent companies out there that will go slap fraudulent liens on vacant foreclosures just to hope that you pay them off instead of waiting the 90 days to wipe it out. Okay. Once you've bought these notes, got them back on track, get the borrower paying for a period of time, you can sell the note as a reperforming note. It's now a performing note. If you got some down payment and the borrower's making 6 to 12 months of payments, you really need a third-party servicer who's collected the payments who can show that independently. I wouldn't just do bank statements or canceled checks or stuff that's just not efficient, not smart in 21st century. I get it. We deal with some people that are not financially savvy where all they have is a money order, have them mail it into the servicing company, and the servicing company can send you a payment history. You can only, if you've modified the loan or they're doing a forbearance agreement, you can't sell off that short-term payment. Sell it off. You have to sell it off the underlying P&I payment of the payment is, okay? And often I can sell it where it's going to be at an 8 to 15% yield, depending on what it is. It may be at 80, 95% of UPB, usually not off the legal balance, okay? Number 11 is bankruptcy loans. I wanted to create a separate category for those. If the loan's in bankruptcy, it has some benefits. You have now a bankruptcy attorney to talk to, which is good. The servicer can help with you. Now, you need to hire a separate bankruptcy attorney to reach out on your behalf, but guess what? You've got an attorney to talk to. BK Chapter 13s, those are going to turn into basically loan modification agreements. It's a restructuring of their debt. Sometimes we've bought loans that were in BK Chapter 13. There's already a chunk of cash sitting at the trustee that we just need to claim. There's already a payment plan in place. But, you know, you're looking at pacer.gov to pull the BK report because every borrower that files bankruptcy has to file this 9-page report, which discloses everything that's underneath the kimono, their values, what they owe, income, all that good stuff. If they come up with a game plan, it's usually going to be over 60 months or 5 years. You can approve that payment plan or decline. Like if their normal payment's $800, they come only want $50. Well, no, we're not going to accept that. They can have the mortgage discharged or kicked out of foreclosure. Okay. But there's a lot of people that like bankruptcy Chapter 13 loans because it basically is a 5-year loan mod. If it is a bad loan, payment plan, kill it. If they don't fall through the payment plan, you can have it discharged and then finish the foreclosure process. Okay. Chapter 7s if it's discharged, then you just pick up the foreclosure process where you left off. Remember, you can suspend the foreclosure process while you're going through this or workouts. Okay, suspend it. Don't cancel it. The only way you would cancel it is if they reinstated or they started a payment plan or they did some sort of modification and you agree to it. And then it stops the foreclosure process and go from there. Now, here's the thing. If you modify it, they make a few months of payments. Once you modify it, they stop paying again. You got to wait the 90 days to start it all over. Okay. Chapter 7 is basically it's a liquidation. No, they don't get to stay in the house. No, it's not wiped free. That debt is still payable. So most of the time it's going to be a foreclosure. Sometimes it can be a deed in lieu. Most of the time we'll just finish the foreclosure. Okay. If the borrower's the family doesn't keep the house, no, the debt doesn't get wiped out by Chapter 7. Okay. It's basically, hey, we're going to forgive you, deed the property over and walk away. Okay. They won't comply, then you foreclose and go from there. Okay. Questions about that before moving to session 11? One thing to ask when you're looking at notes is ask where it is in the foreclosure process. It's already in the foreclosure process. Where is it? The attorney should be able to provide some sort of insight to the seller or the lender, whoever has it right now, but where it is, estimated foreclosure date, what's going on with the deal. Okay. In this session, I want to go through some of the things that you got to think about. It's like many of these things you got to think about in traditional real estate, but I wanted to bring it up for those that are brand new. All right. And are you going to have to consider every one of these and everything? No, but it's good to know what to ask for. And I try to do kind of a brain dump for you. All right. Things to consider before buying. Okay. You're going to ask when you're bidding on a note and going through due diligence process, you're going to ask for the servicing notes. What's the conversation the servicer is having internally? You're going to ask for the payment history, full payment history, start to finish. You're going to pull market values, whether either have a realtor pull comps, or you're going to pay for a broker price opinion for $50 to $100 to give you an idea of value. You're going to look at days on market. We all know days on market have expanded. If it gets beyond 180 days, average days on market, don't do the deal or discount the deal. Okay. Repairs needed are always going to be difficult. If it's occupied, you know you're going to need paint and carpet or updating. Okay, if it's been vacant, you're probably going to need a whole lot more than that. And overestimate your repairs. Don't go skimping on this. Okay, things are getting more expensive. Keep that in mind. It's probably why you want to avoid doing rehabs as best you can. Look at the foreclosure time frame. What's going on? Like in Florida, many of the times you've got to go into forced arbitration with the borrower if they're there. And that can delay things another 90 days. So count on if it's 30 days, count it to take 60 or 90 days. If you say it's 90 days, count it to take 6 months. Things will get delayed and things will happen. Okay. Look at the neighborhood variable. Is it a good neighborhood? Is it in a crack house area? Like I was looking at this one in Minnesota. Well, I found out that you can only, if you're going to go fish it, you can only catch one fish out of the lake. Or that the local Indian tribes are trying to claim back the real estate around the lake. That can be a neighborhood variable. It can be kind of scary. Look at zoning violations or issues, you know. Like what was I going to say? Is there issues with the city when it comes to, is it near like a homeless shelter? City government issues. Is it in a good city or a bad city? All right. Like Austin is a great city, but the city councils are freaking idiots. Okay. Look at crime maps. Is it in a bad area like Gary or Memphis or Chicago? You know, every city's got good side of town and other times have bad sides of town. Some of them are pretty bad. Okay. Look at the size and population of the city. We talked about this. Looking at cities that probably have 50,000 people or more and going from there. The exterior condition of the asset. Look at what is it? Is it paint good? Is it the lawn mowing? Now, while the lawn mowing can often be the next door neighbors, look at what's going on in the backyard. You know, is there emotional equity? Is there flowers? Is there landscaping? Is there kid toys? Those are all great things to help out. You know, it's in a rural location, avoid rural. Just even if it's on the outskirts, if it's in a city, it's 50,000, but it's way on the outskirts of town, it might be too rural for you. Hard to get somebody out there to take a look at it. Local colleges. I like buying in cities that have local colleges, no matter the size of the college. That means it could potentially be a rental if you're within a couple miles of the college. It's an alternate exit strategy for you if you can't sell it. Does your asset meet your strategy? Is it going to make the first strategy of cash flowing if they start performing again or reperforming? Of course, when it doesn't, if they won't perform, and if you can get a deed in lieu, that's a bigger check, or selling it off as an REO, that's a bigger check. Now, if you're looking to grow your assets, you know, that's a third thing in line. Is it going to make sense to hold this property as a rental portfolio? Do you want to do a new note origination where you owner finance the house? I would not do that. That's just not my favorite thing. Can you do it? Yes, but it's going to tie up that equity for a while. Most people don't. They love the idea of owner financing the house. They don't realize it's a death trap if they ever have to sell the asset. Okay. Avoid weird assets and unfinished projects. Does the asset have three profitable solutions? Three profitable solutions. Does it make sense that they start paying on time? Does it make sense to do a deed in lieu? Does it make sense if we foreclose and take the asset back? Now, like if it's a vacant asset, well, guess what? It goes, that reperforming asset doesn't make any sense. Like if it's a reverse mortgage borrower, then you basically, the one strategy that's just to foreclose. And so you have to be prepared for that exit strategy. Okay. If it's an occupied asset, it's got to have a profitable ROI. It's a reperforming. Like I say, deed in lieu, cash for keys, that's a must. Foreclosure REO, so this is definitely a must. That's my worst case. I don't want to do a rental. I don't want a new note original sale. I mean, I've been there, done that. Just don't want to deal with it, create another job for me. Okay. Has the legal started? Ask to speak to the attorney or get a legal update exactly where they're at. Review the servicing notes and collateral file for hardship letters and background of the bar. There's so much stuff in the collateral files and servicing notes that just blows away. If it's a bankruptcy filing, check BK with pacer.gov. Review the state statute of limitations. Some states have a shorter limitation when it comes to what you can charge as far as back payments. So like if a borrower hasn't paid in 10 years, and the state only has a 4-year statute of limitations, guess what? The 6 years, the oldest, you can't go after that interest. You can go after the most recent 4 years. Is it a safe harbor state like Florida, Colorado, Nevada, where if you foreclose, the HOA is only going to be due a percentage of the back fees or a percentage of the sales price? You know, in Florida, there's safe harbor where the HOA is only going to get paid, or the condo association will get paid 1% of the original sales price. So if it's sold originally for $500,000 back 5 years ago, you're only going to have to pay the HOA $5,000. not the 30 grand they're due or anything like that. Another thing in Florida, make sure there's not any special assessments that are going to be due while you're owning the asset. Some of these high-rise condos are having 20, 30, 40, 100 grand special assessments to update the buildings, and that can be pretty pricey. All right, let's dive into due diligence. All right, so the note due diligence process is pretty easy. You're looking at three things, not just the property. You're looking at the borrower, the property, and the collateral file, the loan file, okay? We got a longer video on going through all this stuff. You can check it out in note due diligence there, that link. Borrower due diligence. You're going to get servicing notes, how responsive the borrower is, when was the last time they had right party contact, and they've been a trouble, pain in the ass. They told the servicer to go F off, lied, so they're going to make payments and do stuff. There's all sorts of things, you know. Look at the previous loan documents. Maybe there's a hardship letter in there. Maybe there's a loan application of what they filled out, of what they had as assets or what they were doing. Look at the bankruptcy filings, if there is one. Go to Spokio or White Pages to look to see if their current phone numbers and addresses match up, or they've got family. And then go social sleuthing. Look at social media. Do they have a Facebook profile? Do they have LinkedIn? What are they posting? I found amazing, interesting things about our borrowers who post there. Good things and bad things. Okay. And part of it is looking online. Do they have other family members? Do they have other things? Do they own a business? Who do they work for? Can you find that information online? Okay. And like what we used to do with COVID, if somebody said they couldn't pay because they were laid off, well, who's their past or present employer? And we call. Are they laid off? Are you in business? What's going on? The property, pretty simple, but a little bit different. Look at your values on the front end side. You're only going to use online values on the front side. Then when you make a bid, if your bid's accepted, then you go to paying for due diligence like a BPO, okay? You're going to look at as-is value and take a 30-day quick sale price from your comps, okay? If days on market is 6 months, you can't take the 30-day quick sale price as value. It's got to be the 6-month value because that's what it is, okay? Look at exterior condition, in good shop. Does it need to be painted? Is the roof good? Is the roof old? What's going on in the market conditions? Are things slowing down like that we see right now? Always put eyes in the ask for funding. If it's a vacant, peek in the windows, okay? So important to do that. So with due diligence on the borrower, has different on the commercial side. It's very different on the commercial side. You got to look at leases. Try to figure that out. Most of the time, the banks will have the cash flows and the rent rolls and stuff like that, so you'll know what's going on. Or leases in here, or occupancy. Maybe you go out and have someone go out and visit the property. Every commercial asset is different, and how you perform due diligence. I don't have time to go through how you perform due diligence on a self-storage or on a multifamily. That's all different. You've got to do that due diligence like you're buying it, but then compare it to where it is on the debt side. Because if you end up taking the asset back, you want to make sure that asset cash flows. Just because you can buy a strip mall for 40 cents of the dollar doesn't mean it's a good deal. You know what I mean, Parnell? You got to have a strategy for that. You got to know what you're going to do with that asset if you take the commercial back, okay? If you buy it at a cheap discount, is it going to make sense to modify the borrower or the owner, or is it going to make more sense for them to deed the property and you to control the asset, okay? Commercial is the big boy game. Look at recent nearby sales and comps. Are the comps the same as yours? Are they clean? Are they rehabbed? Are they vacant or trashed out assets? Pay for a broker price opinion from a realtor. You know, if you've got a local realtor friend, they can use a CMA. You can use NAR, RPR if you want to, but be careful if they're not there locally. Look at taxes owed and pending tax sale. Call the county. Hey, I see there's $5 grand back owed. When's the tax sale taking place on this asset? Okay. Look at code enforcement liens. Call the county. Hey, do you have any code enforcement liens on this area? Are they easy to fix? You know, look at the neighborhood activity. Is there drugs? Is there violence? Is there, like Memphis, you got to know street by street if it's a good area or a bad area. Is it a good street or a bad street? Has there been a previous MLS or rental posting? You'll often find a lot of information from previous postings. If it was listed for sale in the last 12 or 24 months, you know the borrower is trying to sell the house. That's a good thing. It works in your favor. Okay. And you know that borrower is motivated to maybe walk away. Look at rent rates. How does the rent rate for that property compare to market rent rates? If it's low, it's probably a rougher area. Is it higher? Can you make money keeping it as a rental? Usually a lower ROI. Look at the HOA or condo association limitations. Like in Florida, there's often these limitations where you got to be 55 plus to live in a community. Or you can't rent it. It's got to be an owner occupant. So then your only strategy is either to sell it or owner finance it, not to rent it out. With any special assessments, we talked about that. Look at the crime maps. I can't tell you that's so important to look at the crime maps. What kind of, if there's a crime map for a city, what's going on in that neighborhood? Is it the Latin Kings? Is it the Bloods, the Crips, the Triads? What's going on? Like, what's going on in the neighborhood? You will often not get access to the property. Okay. If it's a traditional note, a first lien, you might be, if it's vacant, go peek in the windows. Okay. If it's a reverse mortgage, you may be able to go and access that. But most of the traditional first liens, non-performing, you're not going to be able to get inside access. If it's occupied, you sure as hell not going to go knock on the door. And you cannot talk to the borrower, hey, do you want to modify? Before you own the note. That's a violation, and you can get a big bad trouble for that. Okay. Use Zillow values up front for due diligence, and then pay for due diligence after your bid's accepted. Okay. NARRPR.com is a free tool that pulls automated valuation models, basically just an online value. It's not bad, but get a local realtor to pull comps one way or another for you. Call the utility departments. This is one great thing that we do when we're getting ready to buy a note. We call to see if power's on, if gas is on, if water's on. If it's not, then it's probably vacant. We've had the utility departments tell us all sorts of stuff like, oh, yeah, they were in here fighting, or it's been on a payment plan. It's been on, it's the same name. It's been on it for 4 years. So they often give you, because you're the bank, remember. So they'll give you more information because you have vested interest versus just some Tom, Dick, or Harry that's calling. Okay. Make your bid. If your bid's accepted, great, and you find values or issues that affect it, then cancel your bid and reduce your bid or fade your bid. If values come back or other things happen. You know, sometimes it's important to win the bid and then get a lower price through your due diligence. Okay. Can't say this enough. Always put eyes on the asset. Put somebody in there. You do not need to fly out and take a look at. There's investors, people that will go drive by. I think you pay $40 from like Baldwin Advisory Group, and they got somebody that will do a drive-by inspection, take a photo or two from their car for you. Okay. Collateral due diligence. This is important, just as equally important, if not more. Okay, because you got to make sure that all the collateral's in place. Make sure the original loan documents or the mortgage is in there. You know, if the mortgage is missing, you'll need to get a lost note affidavit. That's okay. For every time that note has been sold, you need an assignment of mortgage for every time. So it's called a chain of assignment. So it's been sold 4 times. You need to see 4 assignment of mortgages. You also need to make sure there's an allonge, which is just an endorsement. It's a 1-page document that goes along with every assignment of mortgage. Make sure the deed of trust is filed. Okay. Like what happened, maybe you heard what was going on with Graceland. You know, Elvis's home. Somebody was trying to foreclose for $3 million, but there was never a lien filed. They were just trying to fraudulently foreclose, and there was never a lien filed at the county. So the district attorney and the secretary, attorney general got involved, and they realized this was a fraudulent foreclosure against Graceland, and were able to get it kicked out. Okay. Look at a previous appraisal. It can kind of, that'll be in the collateral files. You maybe it'll see information on there, how the property's set up and what it looks like to make sure it's the right property that your realtor is looking at. Send you photos. Okay. Look at the loan application if they're in there. We call that 1003. Sometimes they're in there, sometimes they're not. Okay. And you're always going to get a soft collateral file. A soft collateral file means it's a file. It's a loan file. Be like email, not the actual hard thing. Like this is the hard thing. This is a collateral file. Okay. This is on OneNote. It can be thick, it can be thicker, it can be thinner. Okay. You don't get that hard file until after you've closed. So everything's to be online. Look at it. Take some time. Go through, read through it, evaluate, make a list of what documents are there. It might make sense at you first to have a professional look at your collateral file, make sure everything's there until you get comfortable going through it. I can go through a collateral file, say, okay, this is there, this is there, this is there. Boom. 5-10 minutes, I'm good to go. Others, the first time you look at it, you're gonna be like, what the hell am I looking at? That's okay. It's normal. Questions? Moving on. One thing to keep in mind, guys, is that we did a special due diligence 1-day masterclass that is included with the 3-day course. It's also included with the monthly membership you can go to. So we spent a whole like 4 to 5 hours going through every document in a loan file so you can kind of see what we're talking about when it comes to it. Okay. Team of vendors, you got to put a team. It's not a lone wolf. This is not a one-man marching or one-woman marching band. In note investing, you have a team, and this is one thing that works in your favor. You do not have to be the expert. Ladies and gentlemen, when you're talking to investors, like, listen, I have attorneys that do these. I have servicing companies that are servicing it. It's not me going out collecting and foreclosing. It's not me going out and rehabbing. I got a team of vendors in place to help you out, and they've got the experience. Okay. You got a coach helping you. You're going to need servicing company, maybe 1 or 2 or 3, depending on where you're buying it. You're going to need attorneys. Okay. Madison, Allied, Covey Finn is pretty good. That's in servicing. You need a title company or title rep to pull O&E reports. We use Baldwin Advisory Group. You can also use Pro Title USA if you want to. I like Baldwin Advisory Group. Do a better job, right? In pulling the title reports, see what's on title. You don't need a title company to close. You need somebody to pull title for you, okay? You're going to need valuation or BPO companies. Again, Baldwin Advisory Group's got a vendor list for you to use that they can help you out with. You need foreclosure attorneys. You can go to legalleague100.com to find out there. Most of your servicing companies are going to have a list of vendors that they use to foreclose. You can use those attorneys or get somebody a referral from somebody else and then have them contact the servicing company to be on their trusted list of advisors, okay? If you're buying on a regular basis, you probably need to hire a special servicing company, especially if you're buying non-performing. These can be like your SEAL Team 6, where they go in there much more aggressive in 90 days of reaching out to the borrower. This is going to cost a little bit more, probably another $500 to get a resolution on your non-performing note. And they may also charge a la carte fees based on the success. It's good to have. There's a few other. Singer Law Group is no longer doing it. He's moved on just recently on to working. He closed his law offices, is moved on and working with a bank again. But there are some aggressive loan workout companies. Depending on where you're at, let me know. I'll be glad to refer you to a couple more. Okay. Also, you're going to need somebody to review collateral in a storage company for your collateral files. The more you get, all right. Now, most people will put it with their, gun safe or a safe, or they'll put it in a, safety deposit box to store your files. You need to do that to make sure that the cat doesn't piss on it or the dog chew it up or your kid decide that the loan paper work is great coloring paper. Okay. You need that to foreclose. So store it with a company. Our buddy Joel Markovitz out of California does a lot of collateral review. He'll look at it for you, tell you what's missing. The CSC out of Dallas will review it. Richmond Monroe will review it and fix it. They can also store it for you per month. Most of your servicing companies will store your collateral files for if you want. I don't necessarily recommend that. I've had too many of them get lost or misplaced. So when we get collateral files, we look at them, we scan them, we found checks and keys, all sorts of stuff here locally. Once we look at them and scan them, then we save that new scan as a new collateral file. And then we put it in a storage unit up on the 5th floor. So it's, waterproof, fireproof in a lot of cases. You're going to need realtors, local, realtor.com. Baldwin Advisory Group's got a list of realtors you can use. ActiveRain.com is something that's been around. I don't even know if it's still around still, but we've used it in the past to find realtors. But Baldwin has a realtor network to use in a lot of cases. Okay. You're going to need insurance companies. Ross Diversified, National REI Group, U.S. Risk is another company you can use for insurance, for force-placed insurance. You need property preservation companies, especially with the cold states where they can go in and turn the water off and make sure that you don't end up with an indoor ice skating rink. Okay. Baldwin Advisory Group's got a bunch of these as well too. We just like Baldwin because it's a one-stop shop for the most part. And you can always go to baldwinadvisorygroup.com. Dickie's done a great job with this. He's been around, I don't know, about 8 years now, 7-8 years. We helped him launch a few years back and does a great job providing his services, network of professionals. Go to Baldwin Advisory Group. You need to order BPO, O&E. That's usually the first thing you guys are going to order in pulling values and title work, and it's easy to do it. And he'll give you a discount off your first order with him if you mention me. Okay. Quick question. No questions. Okay. All right, everybody, let's dive into what comes up. We've covered a lot of information today so far. And like I said before, when you start learning the note business, it's going to take you a while. You're not going to learn everything in one spot. There's always a next step to your education process. And that's what I wanted to share with you is that what comes next for you. Most of you are going to watch this, be like, hey, I want to dive into it, but what do I need to do now? What do I need to do next? Well, the next thing that most people do is they sign up for our 3-day workshop by going to notebuyingfordummies.com, HTTP, notebuyingfordummies.com. You can leave the S off the HTTP. It actually goes faster for some reason. And you get signed up there. But there's a special discount for you guys. I'll post that in the link there. Click on it. This is our 3-day workshop. We've been teaching this since 2010. It's always different because there's always new things going on in the market. That's the thing. I keep buying notes. We're doing due diligence. We're breaking down assets. We're going through tapes. We're sharing you how we do things. We're keeping up with the market. Okay? We are always buying. Not everybody is always buying. All right? It's 3 full days of content. We start usually Friday, 9 to 5, Saturday, 9 to 5, Sunday, 9 to 3. We'll take about an hour break on Friday, Saturday. Sunday, no lunch break, except for about 20 minutes. But you know that you can only absorb, your mind can only absorb what your ass can withstand. Okay? This is the thing that's made us the #1 education spot for non-performing note buyers. Okay? Question here from somebody. So, due diligence, about $500. I probably spend less than that because we have so many systems in place. But when you start off, you're probably going to spend $500 for due diligence. You're going to spend, I don't know, $150 for a BPO and probably $100 for O&E report and then other miscellaneous things along the way. If you're going to have somebody review it, store it, yes, so $500 per asset. Okay. But one of the things that we show you there are some of the systems in place to help you find things. We actually go through deals in our 3-day workshop. It's all about finding the deals. Saturday 2 is, day 2 is all about the funding deals. That means looking at the asset, determining what's going on. And Sunday is the due diligence and breaking down, going through the tape, finding the deals to make offers on that make sense, and really separating the deals from the dud. Okay, just because you get 400 notes in doesn't mean all 400 of them are deals. There might only be 10 or 20 on there that are deals for you. There might be none on there. There might be 100. It all depends on what you see, and that's why we dive into that so much. Okay, we throw in some bonuses. Like our next class is June 21 to the 23rd, so it's literally in 3 weeks from that, 2 weeks from today. Yeah, you'll get if you sign up for it today, you'll get the replay to the April class that we taught, so you can start watching those 3 days of classes, start learning, getting more associated with things, and that way you can ask better and smarter questions during the actual live class we do on Zoom. Replay is $299 value. We also host a 4-week implementation call. That's right. On Wednesdays or Thursday after the class for 4 weeks, we will do coaching. We'll walk you through getting started, getting the ball rolling. You'll see what's involved and we'll help hold your hand because let's face it, you go through a 3-day class, you're going to be bombarded with all these things. You're going to know what the hell to implement when you get out of there. We want you to be more successful. So we have a 4-week group coaching on Wednesday, Thursday nights. It's recorded. I mean, it's live, but we record it in case you can't make it. You can go back and watch. Laughlin Associates are going to throw in their entity secrets class. It's a $99 value for you to go and watch a couple of videos on their structuring and entities. We'll also give you the wholesaling and calling banks classes from March. You'll get that included as well. We'll throw in the due diligence class as well. We'll give you our 20 by 20 how to find and fund video training series that we went through, 20 ways to find deals, 20 ways to find funding. That's a really valuable series. That's $599 value. We'll also give you a VIP ticket to our mid-year note convention called Note Camp. That's usually $399. It's a VIP ticket. That's going to be usually 3.5 days of content with about 30 to 40 speakers. It's our online note convention. Live, not recorded, but live speaker sessions with experts, vendors, all sorts of people in the industry. You also get to bring your spouse or business partner at no additional cost. They ain't got to buy an extra ticket or charge extra. It's included. Okay. And then we'll also bring on usually 1 or 2 exclusive pools for you guys to bid on too during the class. So it gives you a chance to actually implement what you learn, make some offers, and get the ball rolling. Okay. That's over $2,500 in bonuses. That's thrown in for free. Normally our class is $997. We like to make it stupid, simple for you to understand that this is where you want to be. We cut that price down in half. If you sign up today and use the code WEEKEND, Go to the link. You'll see. Let me share with you here. Let's go back. So up here at the top, once you go to Note Buying for Dummies, click on the sign up page. Actually, here. This will take you to Note Buying for Dummies. Click here to RSVP your spot. Type in your information. That takes you to this checkout page. So up here it says 1. Yep. $9.97. The special code says apply here. Type in weekend. All caps. Hit apply. It drops it down to half. So $498.50 for all those bonuses, all those classes. It's a great stuff. You'll get a 200+ page manual with it. You have me available to help you out with calls. Okay. A 4-hour calling banks, a 5-hour wholesaling class, a 5-hour due diligence class. There's a lot of great things there for you. Help you raising capital, help you show you how to go find deals for when you're looking for. I mean, literally, it's intense. It's everything you need, basically a business in a box to get rock and rolling. And like I said, the 4 weeks implementation fall is helping you implement more and take your business to the next level. All right, everybody. We believe in this. We love it. We also have a no nonsense, no bullshit money back guarantee. You sign up for the class, and at the end of the first day, you don't like it. You're like, this is crap. Don't want to do it. I will refund your money back. No questions asked. Okay. That's right. If you take the first day of class, like this is not what I like, or you sign up and you watch the replay, like I don't like this, that's fine. We'll refund your money back. No questions asked. Okay. We believe, we know we do a better job than anybody else in helping you with non-performing stuff. Now look, anybody can collect on a performing notes. Performing notes are damn easy to do. Servicing company, go from there. But guess what? What the hell do you do when the shit hits the fan? What happens when they become non-performing? What happens when borrower stops paying? Then you need to know what to do. Okay, that's why it's important right now, because we've never seen. It's never been a better time to be a note investor. Maybe back in 2010 was pretty good to 2014, but we're seeing things happen again. If you want to tap in and build wealth, this is the time to be doing it. Be buying notes, be talking to banks, be getting lists sent to you that nobody else is seeing. It's a phenomenal time to make some things happen. All right. And that is our notebuyingfordummies.com. Like I said, use the code weekend to get a discount. If you can't afford the $498, then what you'd want to do then is sign up for our monthly membership at $97 per month. If you go to noteumbrella.com, this is minimum 6 months, okay? But you'll get a ticket to the workshop. You'll get access to replay videos. And so it basically spreads your learning costs out more nicer per month. Now, here's the thing. You got to be around for 6 months. If you cancel, we're going to charge your card the remaining balance if you do it before 6 months. Okay. But this spreads your learning costs out, be more affordable. You can also get coaching calls. We've got a special Basecamp group for our monthly members to take advantage of and dive in there and stay attention. Because we have, Monday at noon, my time, we do a weekly coaching call that you get access to. Okay. So that's noteumbrella.com. Type that in the chat roll here for you. And that's just $97 per month. And some people, that's what they want to do, and they want to upgrade later on. Now, others things, if you really are serious about wanting to do this and you want somebody to teach you how to do this and do it in a fast track method, then you definitely want to check out our note coaching or one of my note coaching program. This is basically a 6-month program to help you really kick ass and take names and show you what's involved with it. Once you've gone through our 3-day workshop, and we'll actually credit what you pay in the workshop towards this, you get 8 weeks of coaching calls with yours truly. We'll meet morning, noon, or afternoon. That works best for you. Sometimes on the weekends. That's 8 to 10 weeks of helping you focus on getting deals done and getting funding going. We'll get you making offers ASAP. All right. Every one of our students has made offers within the first 30 days. Now, I take that back. One didn't because they weren't ready to. They were like, oh, I'm going out of town. I can't make an offer. That's fine. But we want you closing deals. Okay. So we're going to get you helping you make your offers. You got 8 weeks of coaching calls. We're going to give you a list of asset managers. We're going to give you your top 12 hedge fund managers to contact in. We're going to help you with raising private capital. We're going to help you set up your pitch deck. It's all live via Zoom, so you don't have to jump on a plane immediately. Those 8 weeks of coaching calls, helping you get deals closed, helping you make offers, me looking through deals, bringing deals to you to make offers on. After those 8 weeks of coaching calls, then you spend 2 days with me here in Austin. You fly in, spend 2 days here in Austin. Sometimes we'll fly out, depends on where you're located. And then that's the whole goal, is to help you make your money back on this. After that, in 90 days. Usually after that, we'll do a 6 months follow-up call. Sometimes it's faster, sometimes it's slower. A full day Zoom of whatever you need help with and going through. Most people are contacting me still. You get weekly calls. They can schedule a call with me at talkwithscottcarson.com. Hey, I'm looking at a bid. Can you help me out with that? I mean, we're here. We say it's a 6-month program, but really it's a year-long plus program. We've still got people we coached 2 years ago that reach out to me about once a quarter. Hey, do you mind taking a look at this asset? Now, yes, this is a bit more of an investment, okay, because you get yours truly, not some employee, me working with you. And I only can do a limited number of these, okay? We don't do 20 of these a month, okay? What we do is try to bring on 1 or 2 people a month. We've actually got 3 spots available for us to do right now, okay? 3 new spots available because we've had 3 people graduate. 3 people are closing deals. They've made their money back on us. Now, it's a little bit more expensive, but we do have payment plans to help you fit your budget. Our cost for our one-on-one coaching for the 6-month plus program is $25,000, okay? I know it's been an investment, but our goal is to help you make that back with your first deal, okay? Now, if you want to do a pay in full in 30 days, we'll honor that and give you a $5,000 discount if you can pay in full in 30 days. We'll knock $5,000 off, pay $20,000 in 30 days. You're good to go. Okay. Can't pay it off in 30 days, then we can structure payments for you. A payment plan, bring something down, and we'll charge you monthly. We've got people that are paying over 6 months. Okay. They brought, what they bring, $8,000 down or $9,000 down. They paid $2,000 for 6 months and one final lump sum payment. But what they did with that lump sum payment was that they closed on a deal, paid off their coaching. Okay. Our goal is to help set this stuff up so you're making monthly cash flow going on. Like I said, it's a full year coaching. If you want to hang around a little bit longer until we close your deal, we will work with you as long as we can until you close your first deal. All right. I mean that from the bottom of my heart. We want you to succeed. All right. And that's what's so powerful is that we've done such a great job helping people really knock it up. And we have a 95% success rate. The 5% of those that disappeared, we scared them off. We're like, oh, crap, this is not for me. That's their choice. You can lead a horse to water, but can't make a drink, right, ladies and gentlemen? And this is not putting 40, 50 hours a week, hours in per week, 5, 10 hours a week. We work with you. You get a little bit of something to do each week. We want to keep you motivated, keep you rock and rolling. You got to do a little bit. I can only do so much for you. You actually determine your success, okay? But if you'd like to do this, like to talk more about this, please reach out to me, talkwithscottcarson.com. It's easy to make an appointment with me. Just go to talkwithscottcarson.com. And let's jump on a call. See if we can find a payment plan that hits your budget or tell me what you're looking for. We've got a couple of different things that are available, okay? Like I said, we do have a third party that will actually finance it too for if you want to do this. They'll do it over like a 2 to 3 year period. If you got 2 years of work history, W-2s approve that. If you make about $40,000 or more per year, you get a 620 FICO score or greater. They can do payments as low as like $500 a month or less. Depends on where you're at credit score. I don't handle that. There's no prepayment penalty. We've had people have done this option. They don't have to make your first payment for 30 days, and they're already making money in 30 days because we help them buy now. We just had John Gore, who's one of our coaching students. He's coming out this month sometime for his 2-day, and in his first 60 days, he closed on 20 notes. In his first 30 days, he closed on 5 notes, okay? And that money is bringing in a 21% after expenses, cash and cash return on his portfolio on his money. Pretty good. Okay. I could give you, Larry Hoffman's made 6 figures. Catherine Bell's made 6 figures. Trust me, we are here to work with you to help you kick ass and take names. Okay. If you, is this for a residential or commercial focus? Either or. Now, here's the thing. Do you have a background in commercial notes, Parnell, or commercial real estate? This is primarily for the residential side. If you're doing it, I can only commit because there's a longer process for due diligence on the commercial side. If you don't have any experience in commercial real estate, if you do, great. Then we can talk. Then we can customize a plan for you on stuff like that. Yeah, it's about the same price if it's just be the commercial side of things, but it's a little bit different in what's involved with it. So why don't we schedule a call and I can go through that and can talk with you, pick your brain out a little bit. This is for the residential. That's where most people start. Then they move into the commercial. If you want to just go straight on the commercial side, then let's talk. We can definitely go through that, and we can. It's still a weekly call, but it may be a little bit longer on the calls before you come in. But we've got a plan for you as well. But most people want to start from the residential. That's fine. We can do that for you. Anyway, if you want to see if you can get approved for this, you can go to a link and get approved usually in hours, not days. If you go to bit.ly Scott's Coaching, you can get signed up and see if you get approved for the financing option there for you. Or in some cases, you've got some experience. This might be a better fit for you too, Parnell, where you just need a one-day thing with me because you've got some experience. Come and spend a day with me here in Austin, Texas, a little bit of work beforehand. We've had people take me up on this. This is $10K just for a VIP day. We focus from basically 9 to 6 on what you want to focus on. If it's commercial notes and you already feel good with the other things, we'll dive in just showing you get deals. You need help with just raising capital. You know, we do this. We offer this for folks. You're still going to want to sign up and take the 3-day course as the basics before you ever do something like this. Okay, I want to make sure we're speaking the same thing because I don't want to be teaching the bare necessities during that one day. The one day is action plan, making offers, reaching out, putting systems in place there for you. And this VIP day is 10K. And you can split that up with half beforehand and half the day of. Okay. But no, we don't do monthly payments on a VIP day. All right. Just don't do that. It's got to be paid in full, either at the event, half up front to secure it, and then the other half when you arrive. Okay. But some people have done this. They're like, hey, I want to focus on just on apartment notes. Okay. Great. You know, I don't want to deal with the residential side. That's fine. Let's have you come in and spend just a day with me here on the VIP day. So we'll do one of those about a month. So basically, let me know if you're interested. We're glad to help answer your questions and take your business to the next level. We've got a variety of ways, guys, to structure these things to help you fit your budgets. Okay. Any questions, any comments, concerns? We usually do the VIP day Tuesday through Saturday. It's a full day, just like I said, focused on you. You fly in. If you want to spend the night before, great. Some people fly in early in the morning. We pick you up at the airport, head to the hotel, work on your stuff for the day, and then we'll drop you back off. Okay. If you've got a lot of experience, you want to focus on that, great. But like I said, one thing we do on the coaching or the one day, if you signed up for the 3-day course, we'll apply that $498 or whatever you paid for 3-day workshop towards the balance. Okay. What happens if the borrower pays off early on a performing note as far as the yield return? It means you go through the roof. The borrower pays off early. That's a good thing. That's always a good thing. They refinance you out. Yield goes through the roof. Good stuff. All right. Anyway, any other questions, comments? If you guys want to talk more, talk with scottcarson.com. Once again, our class is June 21st and 23rd. Get signed up today. Discount code is weekend for you to take advantage of that. Any other questions, comments, concerns before we let you go for the rest of your Saturday or the rest of your Sunday if you're watching the replay? All right, then, everybody. We'll see it breaking down the tape for our 3-day workshop. Takes too long. All right. Thank you so much for joining me here today on Note Weekend. We hope you found this valuable. If anything, guys, hopefully you walked away more knowledgeable, more ready to rock and roll some things. If you've got some specific questions or a specific scenario you want to run by, please feel free to reach out to me. Talk with scottcarson.com. I'm glad to talk with you, let you pick my brain, and I'll give you my honest opinion, give you my honest counsel on what you're working at. Some people have these great ideas. I'm like, it's a whole lot of work. Why don't you just do A and B versus trying to do A through Z? And it makes a lot of sense. We've been around for a long time, got a lot of great connections, and we've helped create a lot of success for people out there. So go out, take some action, everybody, and we'll see you at the top. All right. Thanks for joining us live. Thanks, Barbara. Thanks, Sandor. Thanks, everybody.